Good morning. Please take your seat. So, yesterday I think we have completed till audit documentation and evidence. So now let us start with the standards on audit. So we have altogether 8 standards for classroom discussion. So let us try to take it up, the key aspects or important content from this standards one at a time. Okay, so we'll start with essay 250. And one more thing, when it comes to standards, there is some extra added information in our study material. That too in chapter number 1. When you open nature, objective and scope of audit, there will be a section for standards. So there they have given what is the specific purpose of different standards issued. Like as I have told you in the introduction of the standards on auditing, there will be 4 kinds of standards. One is standards on audit, standards on review engagements, standards on assurance engagements, and standards on related services. So like this, ICAI broadly gives standards under 4 categories: standards on audit, standards on review engagement, standards on assurance engagement, and standards on related services. So we know that standards on audit are applicable whenever we are conducting audit assignments of historical financial information. So if we are doing audit of the historical financial information, the past financial information, so then that assignments we call them as audit assignments, and then we are required to follow the standards called standards on audit. So the next thing comes review assignments. See, we say auditing is a reasonable assurance, whereas review engagement is a limited assurance. This is what the term they have used there. What kind of engagement is standards on what kind of engagement is review engagement? Limited assurance engagement. That means even it is lesser than the reasonable assurance. So whenever we are conducting review of historical financial information, once again, so that we call it as review engagement, and whenever we are doing review, we need to comply with the standards called standards on review engagements. Like quarterly financial statements which will be released by the listed companies will also be checked by the auditor, but we don't call it as audit, we call it as what? Review. So whenever you are doing this review of historical financial information, then SRS will be applicable. The next one is standards on assurance engagements. They will be applicable whenever we are verifying, whenever we are associated with other than historical financial information. What we are associated with? Other than historical financial information. That means at various times we might be required to certify the client's future or projected financial statements. So whenever we are associating ourselves with other than historical financial information, like future financial information, so then that assignment we call it as assurance engagement, and for that assurance engagement, standards on assurance engagements will be applicable. The final one is standards on related services. These standards becomes applicable when we are performing agreed upon procedures. What they say? Agreed upon procedures. Like being a chartered accountant, I need not only do that audit or review. That is not only my scope. Even if I want to do accounting services, that also I can do it. If the client is coming to me and asking me to prepare financial statements, that also I can do it. So like that, if you agree to perform agreed upon procedures, that assignments we call it as what? Related services. And whenever we are doing related services, you need to comply with standards on related services. And to maintain the quality of all this kind of assignments, it could be audit, it could be review, it could be assurance, it could be related service. To maintain the quality in all these kinds of assignments, Institute has come up with one more standard, SQC, standards on quality control. So these 4 standards put together, all the four standards, we call them as engagement standards. For protecting the quality of the engagement standards, ICAI has come up with one more standards called SQC standards. Standards on quality control. This SQC will be applicable even if you do audit assignment, even if you do review assignment, even if you do assurance assignment, even if you do related services. See, a question has been tested regarding this in our recent RTPs also, and it is amended in our board materials also. So whatever I have explained now, that you will be able to find in our chapter number 1, nature, objective and scope of audit. In the study material, you will be able to see this content in the highlighted and in the bold format. Go through it once. I have explained everything here. Just have a look once. Why? Because as I was telling, since it is amendment and also recently tested in the RTP, so I do guess some sort of MCQ or descriptive or some sort of true or false statement could be tested from these areas. Clear everybody? Right. So this is one thing which was added. So having said that, now we will start with the discussion regarding each and every standard in detail. So we'll start with SA 250. What does SA 250 deal about? Auditors' responsibilities related to laws and regulations in the audit of financial statements. This standard talks about that laws and regulations which the client is required to comply, not the auditor. Those laws and regulations which who is required to comply? The client is required to comply. And you tell me first, it is whose primary responsibility to comply with all the laws and regulations? It is a management's responsibility. Auditor is neither appointed to prevent the non-compliances, or even we cannot expect the auditor to detect all the non-compliances also. The primary responsibility is with whom? Management of the company. They are ensuring for preventing non-compliances. At the same time, they are even responsible for detecting the non-compliances if any happens. Clear everybody? Now, for the purpose of auditor's responsibilities, this laws and regulations are divided in this standard into two categories. How many categories? Two categories. So, for auditor's responsibility, laws and regulations are divided into two types. Type 1 laws and regulations, type 2 laws and regulations. Type 1 laws and regulations are those laws and regulations which have a direct effect on determination of amounts and financial statements. Examples of such laws: Income Tax Act, GST Act, PF Act, Gratuity Act. So these are those laws and regulations which are even Companies Act. So these are those laws and regulations which have a direct effect on either amounts or disclosures in the financial statements. Type 2 laws and regulations are those laws and regulations which have no direct effect, but since they don't have direct effect, we can't say we need not comply also. Compliance with these laws is required even though they don't have direct effect on financial statements. Why? Because if you don't comply, either you have to face the consequences like penalty, or sometimes they may be fundamental for continuation of the business. So for the auditor's responsibilities, we have divided into type 1 and type 2. Auditor should be more concerned about which laws and regulations? Type 1 laws and regulations. Even standard also says the same thing. When it comes to type 1 laws and regulations, auditor's responsibility will be to obtain sufficient and appropriate audit evidence. That means you need to perform in-depth audit procedures and find out whether type 1 laws and regulations are all complied with or not. You have to perform in-depth audit procedures. Whereas when it comes to type 2 laws and regulations, here standard is not expecting you to perform in-depth procedures. Here standard is expecting you to perform only limited audit procedures. What the standard is expecting you to do? Limited audit procedures. Sir, where this limited audit procedures are stated? The limited audit procedures are stated in the same standard SA 250 only. So what are those limited audit procedures? Nothing but they are inquiries only. But inquiry we are supposed to do with different people. Inquiry we have to do it with management and those charged with governance. Inquiry has to be done with licensing or regulatory authority. Inquiry needs to be done with internal legal counsel if there is any. These are the only things which you are supposed to do. For what laws and regulations? For type 2. Whereas when it comes to type 1, our responsibility is to perform in-depth audit procedures and try to obtain audit evidence. And what do you mean by non-compliance? They define the term non-compliance there. How do they define? Non-compliance refers to act of omission or commission, which is against to the existing laws and regulations, either intentional or unintentional. So that is what we call it as non-compliance. Then the next important part of the standard is auditors reporting. How this laws and regulations is going to have an impact on audit reporting. Very simple. Here we say 3 circumstances. When laws and regulations are complied, there are no compliances. So all the compliances are perfectly done. Will we give what opinion here? Unmodified opinion we will give. Since all the laws and regulations are complied, I am not able to find any non-compliance. So directly I will go for unmodified opinion. If after performing audit procedures, you came to know that there are some non-compliances with the laws and regulations, you have evidence and concluded that there is a non-compliance, then what we are supposed to do? So before modifying the opinion, first we need to check whether proper disclosure is given in the financial statements or not. Adequate disclosure is given in the financial statements or not. If the adequate disclosure is given, then what opinion? unmodified opinion only. If the adequate disclosure is not given, then modified opinion only. That too, what kind of modification here? What kind of modification? Either qualified or adverse. If the effect is only material, qualified. If the effect is material and also pervasive, adverse. Next, sometimes auditor will not be able to obtain audit evidence. No evidence to conclude whether laws and regulations are complied with or not. There is no evidence for the auditor. Then what he is supposed to do? Directly modify the opinion. Here what kind of modification? Either qualified or a disclaimer. So if the effect is only material, qualified. If the possible effect is material and also pervasive, then the disclaimer of opinion. Understood? Clear everybody? So this is the most important part in the standard when it comes to reporting, how the compliance of laws and regulations will have an impact on auditor's opinion. Clear and comfortable? Right. And one more, some things which they tell, audits they tell in the standard is indicators of non-compliance, they will say. That means these are those factors. If you come across these factors, you should get a doubt that here there could be a non-compliance with the laws and regulations. What are those? Adverse media comment, inspection by the regulatory authorities, payment of fines and penalties, or unspecified payments to the government employees or related parties, or adverse media comment, as I have told, transactions with the tax havens, having a subsidiaries in the tax havens. So these are all the examples of indicators which give a hint to the auditor there could be a non-compliance of the laws and regulation. Understood everybody? Comfortable? Shall we proceed with the next one? Right. So with this we are done with essay 250. So now the next standard which we are supposed to discuss is essay 501. So essay 501, what is the title of the standards? Audit evidence, specific considerations for selected items. Nothing but essay 501 is also talking about audit evidence. We get a doubt, sir, essay 500 is also talking about audit evidence. No. So essay 500 is talking about audit evidence in general. Yesterday as we have revised at the end, audit evidence related discussion, all that is essay 500. But essay 500 is talking about audit evidence in general. Whereas essay 501 is also talking about audit evidence only, but it is not a general standard. It will give us specific considerations which we need to consider while conducting audit of 3 selected items. What are those 3 items which are selected here? First one is existence and condition of inventory. Second one, litigations and claims, completeness of litigations and claims. Third one, segment reporting. So let us try to understand what needs to be kept in mind while conducting audit of each and every area. First, we will start with existence and condition of inventory. To obtain existence and condition of inventory, what auditor is supposed to do as per essay 501? The standard simply says, whenever management is doing physical verification, attend that management's physical counting. Attend management's physical verification. So whenever management is conducting physical verification, they will intimate the auditor, they will let him know. So as an auditor, you try to attend that physical verification whenever conducted by the management. And by attending there, what I am supposed to do? Try to obtain an understanding what procedures they are following. Observe whether they are doing the work as per the plan or not. Observe their counting procedures and also test to check some quantity of inventory on random basis. So like this, you try to go and observe that. Sometimes what could happen is management has conducted physical verification. They have even intimated you also, but you were not in a position to attend. You did not attend. Then what is supposed to happen? So then the standard says, if you are not able to attend management's inventory counting process, you try to do the counting on your own on some alternative date. So auditor should do physical verification when he is not able to attend management's physical verification. So when he is not able to attend the management physical verification, then he has to do it on his own on some alternative date. So management called him, he did not go. Subsequently, he thought of going on his own, but it was also not possible because of some unavoidable circumstances. So physical verification is impracticable. You did not go when the management is counting. You thought of going on some other date, but then at that point of time, it has become highly impracticable because of some natural calamity or social riots or whatever it is. So it has become highly impracticable for you to attend now. Then what we are supposed to do? then the standard says that first, if it is highly impracticable, try to think of any alternative audit procedures. If alternative audit procedures give you evidence, if alternative audit procedures also not giving any evidence, then what we are supposed to do? Modify our opinion. What kind of modification here? Either qualified or disclaimer, because it is a case of non-availability of evidence. And however, they say one thing here: the difficulty of time and cost cannot be used in itself as a valid basis for omitting physical verification. You cannot say the client is located at a distant place, they have to travel, I have to incur a lot of cost. So that is the reason for impracticability. You cannot say. When I say impracticable, that should be because of some circumstances beyond the control of the auditor. Understood? So 3 steps I have told: attend management counting. If not possible, you try to attend it on your own. If that is also becoming impracticable, try to perform alternative audit procedures. And if alternative procedures are also not possible, try to modify your opinion. And one more thing, sometimes your client might be the owner of the stock, but the stock might be lying with some third party. Inventory in the custody of third party. So when the inventory is with the custody of the third party, what we are supposed to do? When the inventory is in the custody of third party, what we are supposed to do? First, try to get external confirmation. If the external confirmation is reliable, well and good. If the external confirmation is not reliable, when you have suspicion regarding how far this external confirmation received from the third party is reliable, then what we are supposed to do? Then we are required to, when it is highly doubtful, then we are required to perform alternative procedures like arranging another auditor, attending it on your own, or checking these documents like warehouse receipt, warehouse challan, etc. And these kind of procedures you are required to perform when external confirmation is not reliable. If the external confirmation is reliable, well and good, you can stop with external confirmation only. Understood? So this is how you are supposed to get the evidence regarding inventory existence and condition as per SA 501. So now the next content, the next item is what? Litigations and claims, completion of litigations and claims. The standard says that first you identify whether there is any risk of material misstatement regarding litigations and claims. To identify that risk of material misstatement regarding litigations and claims, they ask you to do 3 things. What are the 3 things they will ask you to do? First, inquire with the management and those charged with governance regarding these litigations. And also, read the minutes of the board of directors and correspondence with the external legal counsel if any. And also, review legal expenses account. So you have to do first these 3 things. If you perform these 3 steps, that is inquiring with the legal counsel, reading the minutes, and also reviewing the legal expenses. If you do these 3 things, you will come to know whether there is a risk of material misstatement regarding litigations and claims. If you don't find any risk of material misstatement, well and good, you can stop with these 3 items. In case, if you find by performing these 3 items, you find a risk of material misstatement regarding litigations and claims, then we need to perform extra procedures. If you don't find any risk of material misstatement, you can stop with this first 3 items. But in case if you find any risk of material misstatement, then we should proceed further and perform additional procedures. What is that? They say that if you find any risk of material misstatement, try to communicate with entities external legal counsel. And how you have to communicate with entities external legal counsel? Through letter of inquiry. This letter of inquiry will be prepared by whom? Prepared by management, sent by auditor, asking the legal counsel to respond back to auditor directly. Since we don't know how to communicate, whom to send this communication, etc. So we'll take whose help in preparing letter of inquiry? Management. So management will prepare the letter of inquiry for us. We will send it to the legal counsel and ask the legal counsel to respond directly back to auditor. So this is how you have to do. And sometimes what could happen is management will not help you in drafting letter of inquiry, or management has helped you to draft the letter of inquiry. You send to the legal counsel, but the legal counsel is prohibited from responding back to you, or he is prevented from responding. He is not responding even after receiving the mail also. So then what you can do, sir? Then the standard says try to perform alternative audit procedures. Since management is not giving permission, or even management gave the permission, but the external legal counsel is not responding back to me. So in these circumstances, first try to perform alternative audit procedures. If alternative audit procedures are also not possible, then you try to modify your opinion. Once again, here also what kind of modification? Either qualified or disclaimer. Understood? So this is what you are supposed to do. And one more thing, they say that you need to obtain written representations also from the management that they disclose the details of all the litigations to the auditor, and they did not hide anything from the auditor's knowledge. And also in some circumstances, just sending a letter of inquiry alone will not be enough. Sometimes you might feel that you have to go and personally meet that legal counsel when the matter is very significant, and also when there are differences between whatever legal counsel is telling, whatever management is telling. So if there are such a differences, then also you can go and personally meet that legal counsel instead of just sending a letter of inquiry. Understood? So this is how we need to obtain evidence regarding completeness of litigations and claims as guided to us under SA 501. Understood? So now one more, the last aspect of this standard, which is in which the guidance is provided, is what? Segment reporting. So when it comes to segment reporting, what we are supposed to do? See, enough of guidance is already there in the accounting standards. So in the accounting standard, they will AS 17 is there. In the AS 17, they have already told us how to identify the segments. So just as an auditor, what I need to check is whatever has been mentioned in the accounting standards. They mention some calculations for identifying the segments, whether management did that calculations and properly identified the segments or not. If you want, you perform it once again, the calculation, and check with the and compare with the management's calculations, and wherever possible try to perform analytical procedures on this segment information. This is what simply they try to say regarding this segment reporting. Understood? So this is what SA 501 is talking about. Clear everybody? So how many standards we are done? 2 standards. What are they? 250 and 501 we are done. So now let us talk about the next standard, which is going to be 505, which is talking about external confirmation. First of all, what do you mean by external confirmation? It is a direct written response obtained by whom? Auditor from a third party, that we call it as external confirmation. Either that could be in a paper form or electronic form. And even this external confirmation is of 2 types. What are those 2 types? Positive confirmation request, negative confirmation request. What do you mean by positive confirmation request? When we expect the third party to respond, either he agrees or disagrees with the information contained in the request. Or even when we ask information from him directly, instead of asking a confirmation, even if you ask the information directly from him, that also we call it as what? Positive confirmation. So either the third party agrees or disagrees. Whereas negative confirmation request, this we are going to use only when the third party disagrees with the information provided in the request, then only we expect a response from them. That we call it as negative confirmation request. And there's a few more definitions like exception. What do you mean by exception? Whenever there is a difference between amount or information which is there in the confirmation request or the accounting records and the response which is given by the third party. That means in the books of accounts some information is there, but third party is giving some other information. So that difference we call it as what? Exception. Does an exception means always a misstatement? No, exception need not always mean a misstatement. Why? Because there can be a mistake even in third party's books of accounts also. Always your client might not have made a mistake. Even third party also could have done a mistake. So that is what the meaning of exception. And one more thing they say there, non-response. What do you mean by non-response? See, these definitions are important for MCQs. When it comes to non-response, what is the meaning of non-response? You sent a positive confirmation request to the third party, but you did not get proper response. Or you sent a confirmation request, it is returned undelivered. 2 circumstances they say. If the confirmation request written undelivered, either positive or negative, you have sent it but it did not reach the other party, you have got it back, returned undelivered, then we call it as non-response. And if it is a positive confirmation request, it reached the other party also, but the other party is not giving you proper response, this also we call it as non-response. Understood? So this definition is also going to be very important. So these are the few definitions. Now having read the definitions, now let us try to understand what is that external confirmation procedure. So 4 steps will be involved in the external confirmation procedure. What are those 4 steps? First, select the information, identify the information regarding which you want to send a confirmation request. Second one, identify confirming party to whom you have to send this confirmation letter, identify that confirming party. Next one, designing the confirmation request. And finally, sending the confirmation request and do the follow-up. So when it comes to selecting the information for confirmation request, generally external confirmations are more suitable for getting confirmation for amounts and balances. But the use of external confirmation is not just restricted to that. Agreed, we use it for getting confirmation of amounts and balances. That doesn't mean that its use is restricted only for amounts and balances. Even it can be used for getting the confirmation of qualitative terms also, like existence of terms and conditions, whether side contracts are there with the customer, whether the title documents of the of your client are really kept by the borrower or not. So it can be even used for other information also. It is even though mainly used for account balances, but its use is not just restricted to it. Its use is spread across so many other areas also other than amounts and balances. So this is what they say in the first part. Second one, conforming party. You need to choose appropriate conforming party. Why? Because you can get a proper response only when you address appropriate conforming party. So selecting the conforming party is also a very important thing. After that, designing. While designing the confirmation request, we need to keep various factors in mind. Why? Because the design of the confirmation request is going to have a direct impact on the reliability of the response. Like you need to decide on the basis of risk of material misstatement. If the risk is very higher, I will go for positive confirmation request. If the risk is very low, then I can go for negative confirmation request. Also, you have to take a decision regarding whether you have to send the confirmation request in a written format or in an electronic format. That also you have to take a decision. And some third parties will be willing to respond invoice wise details. Then I will send invoice wise information. Some third parties may not be willing to respond that detailed information. There I will ask consolidated information. And some clients will say that we will give you confirmation only if you get an approval from the management. So in that circumstances, I need to attach the approval of the management, then send a confirmation request. So like this, keeping various factors in mind, auditor has to design the confirmation request, whether that should be positive, negative, written or electronic, invoice wise or total information, whether management approval is required or not. So after keeping all these factors, you have to finally design the confirmation request. Once you design the confirmation request, now it will be ready. You have identified confirming party also, design the confirmation request also. What is the last step? Send that confirmation request. And when you send that confirmation request, do the follow-up wherever applicable. When follow-up will be applicable? In the case of positive confirmation request or negative confirmation request? We do the follow-up only in the case of positive confirmation request. Why? Because in the case of negative confirmation request, if you don't get a response, we will assume that the information is correct. So we will do the follow-up where? Only when there is a positive confirmation request. Now apart from that, standard also will say a few more things like when it is suitable for you to use negative confirmation request. So between positive confirmation request and negative confirmation request, which is highly reliable or which is always better to use? Positive confirmation request will be better to use. Why? Why? Because if you send a positive confirmation request and if you don't get a response within time, we will do the follow-up. So in the negative confirmation request, if you don't get a response, we will take it as implied acceptance by the third party. But sometimes what even could have happened is your third party might not have seen that email only. Yes or no? So you will not do the follow-up. So that's why positive confirmation request is somewhat better than negative confirmation request. Does that mean I should never be using negative confirmation request at all? No, you can make use of it. Standard has told us some areas where we can make use of negative confirmation request, where the risk is very lower, or when the items are very small, homogeneous and repetitive in nature, or when you know the third party that there is low exception rate. That means you don't expect more misstatements in that area. And also, you know the third party very well, that he goes through the email very well, and if he goes through the email, he will definitely respond back to you. If you have past experience working with a third party, so in that areas also you can send negative confirmation request. Definitely positive confirmation request is more reliable than negative confirmation request, but there is no compulsion on the auditor to go for only positive confirmation request. In these areas like low risk areas where the amount is small, low exception rate is identified, or you know the third party very well, in these circumstances even you can go for negative confirmation request also. Understood? And sometimes the client might not permit you to send the confirmation request to the third party. You wanted to send the confirmation request, but the client is not permitting you to do it. Then what we will do? Here also we need to identify reasons. So if the management is not permitting to send me the confirmation request to third party, so then also I need to check reasons. If there are valid reasons, well and good, you try to perform alternative audit procedures. If there are no valid reason, that means without telling any valid reason, management is just coming and telling me, sir, you please don't send a confirmation request to debtor. You don't please send a confirmation request to some creditor. So when I ask them reasons, sir, why I am not supposed to send, they are not giving me even any valid reasons also. So in such a circumstances, what the standard will ask you to do is reassess the risk of material misstatement. What they will say? Reassess your risk of material misstatement. Why? Because you now got to know some extra information about management. You don't know earlier that management is not having integrity, but since now they are stopping me from communicating with the third party and they are not even giving valid reason also, so it should create a doubt to me regarding reliability of the management, how far they are having integrity. So that's why reassess your risk of material misstatement. And finally, if by performing alternative audit procedures also, if you don't get evidence, and also without any valid reason, if the management is not permitting you to send external confirmation, in these circumstances try to modify your opinion. Understood? So this is what they try to say regarding what if the management is not permitting us to send a confirmation request. Clear everybody? And one more aspect, what if external confirmations are not reliable? Something like that, they will say one small paragraph, what if external confirmations are not reliable? When generally external confirmations are not reliable? When we know that third party is not independent. When we got some evidence that third party is related to our client, then there are high chances that he might collude with our client and might send wrong confirmation request. So in such circumstances, this written confirmation will not be reliable. Then also the standard will ask you to reassess your risk of material misstatement, and wherever applicable, try to even consider modifying your opinion also. Understood? So this is what SA 505 was talking about. Clear and fine? So shall we proceed with the next standard? Right. So next standard which we will be taking up is SA 580. But before going to this standard, let me see some doubts are there from the live chat. Let me see what is that. Statutory auditors of TRB Limited observed various instances when either the TDS required. Yeah, this is actually a question asked in the recent attempt. So in the recent exams, they have in the recent December 21 question paper, or I don't exactly remember, in the recent one of the question paper, they have asked a question that, so if you are conducting audit of some company, that company made some non-compliances with the TDS provisions, etc. As an auditor, what you can try to do to identify that non-compliances. It is a more of a general question. The content is not there from our board material also. They have generally asked. So if you want to identify non-compliances, what you will do? And what we will generally do is, like as we know, inquiring of the management, we have to go through any communication received from the regulatory authorities, notices which we have got, and also like as I have told you, some indicators, check any payments are made to government officers. So like that very general question they have tested. So you can refer the suggested answer that sir, I wrote this at 250, got 0 marks. So you might not have written a suitable paragraph. I don't know what you have written. So if you have any idea exactly what you have written, then I can help you out. But that question, as I have told, that is something a new question which was not there even in the board material also. Out of common sense, I have asked the question. So if you want to identify non-compliances, what you will generally do. So refer to that answer once from the, I think, December 21 question paper only, if I am not wrong. Okay, fine everybody. So let us proceed now. Right. So we will start now with SA 580. What is SA 580 talking about? Written representation. So now, what is the difference between external confirmation and written representation? See, external confirmation is a direct confirmation which the auditor will get from a third party, whereas written representation is the confirmation which auditor gets from management or those charged with governance. So a written statement or a written confirmation which the auditor receives regarding certain matters or supporting other audit evidences that we call from the management or those charged with governance of the company, that written statements we call it as what? Written representation. And SA 580 is a dedicated standard which is talking about written representation. Written representation are also one of the evidences. But when written representation to be used as evidence, we need to pay attention to one point. A written representation will give you audit evidence, but it cannot be taken as a audit evidence on its own. What does that mean? It means that written representation can only be used as a supporting audit evidence. You cannot use it as the only audit evidence regarding certain matters. Why? Because if the standard says written representation can be used as audit evidence on its own, then audit will be very simple. I will not do any audit. I will get appointed as an auditor, ask the management to give me a confirmation. They will give me a confirmation. We prepare the financial statements without any mistake. I will sign the financial statements and audit report and come back. So that's why what they even say is written representation is like just a supporting evidence. You cannot take it, you cannot use it as a sole evidence. You cannot take it as only evidence. Why? Because it does not provide evidence on its own. It is just a supporting audit evidence. And one more thing, from whom you are going to request written representation? From the management only. But generally from that part of the management who are responsible for preparation of financial statements, like CEO, CFO, audit committee. So we go to that part of the management who is responsible for preparation and presentation of financial statements to get the written representation. But generally what will happen is sometimes when we go to the particular part of the management and ask them for written representation, they might not have complete information regarding that area. Can they skip giving written representation in that circumstances? No. What the standard says, even if the management is not having complete information, it is their responsibility to inquire with others in the organization, get the required information, then provide written representation to auditor. Like I went to the CFO and asked him to give me some confirmation regarding litigations and claims as per SA 501. But our CFO is not that involved with that litigations and claims. Can he say, sir, I don't have information, I will not give you written representation? Can he say it? No. What is his responsibility? Go to concerned person in the organization who handled that litigations and claims. Get all the required information. After getting the information, then give a confirmation to internal audit. Sorry, then give a confirmation, then give a written representation to auditor. Understood? Clear everybody? Right. Who could be that people in the organization with whom management can inquire and get the information? He could be like a actuary. An expert like actuary. Like for example, I'm asking the management to give a confirmation regarding provision. But our management is not having complete information. Why? Because the work has been done by actuary. So what the management has done is they went to the actuary, required all the information, then they have to give the confirmation. Or they can take the help of other people like lawyers, legal experts. If I'm asking about litigations and claims, as I have told, our CFO is not aware of that litigations and claims. What he has to do? Go to that legal expert, get the knowledge, then provide confirmation to auditor. Or sometimes he might take the help of these staff engineers also. Sometimes he might even take the help of staff engineers also. So this help also you can take. And one most important thing which they say in this entire standard is, and which has potential for getting tested in the true or false statement, between date of written representation and date of audit report, which one should be earlier? Between date of written representation and the date of auditor's report, which one should be earlier? Date of written representation always should be earlier. Why? Because what is the process of audit? First audit evidence, then opinion. So that's why the date of written representation should be on or before the date of auditor's report. In any circumstances, it cannot go beyond our date of auditor's report. Why? Because if you say that, you are expressly showing your foolishness there. You are telling, sir, first I gave the opinion, then I got the evidence, sir. Understood? So that's why date of written representation should be earlier, then after the date of auditor's report should be dated. Clear, everybody? Next. And one more thing they say, what if written representations given by the management are not reliable? What if written representations given by the management are not reliable? So if you come across any circumstances which is creating a doubt that whatever representations given by the management, those are not reliable to me, or whatever written representations management given, whatever evidences I got, both are not matching with each other. Management is giving confirmation something else, but I got evidence something else. Then the standard says, try to resolve that matter immediately. Try to do in-depth understanding and find out whether representation is wrong, whether whatever evidence you collected is wrong. And finally, if you came to know that written representations are only wrong, so here also you need to once again reassess the risk of material misstatement. And also the standard says sometimes it would be even appropriate to modify your opinion also. And here they directly say disclaimer of opinion. Here directly they say what? Disclaimer of opinion. When the written representations are not reliable, you have to go for the extreme scenario of disclaimer. Don't go for this qualified less severity. Go for extreme severity and give a what? Disclaimer. Sometimes management will not provide written representation. The thing which I have told you, management provided but not reliable. Sometimes what could also happen? I am asking written representation from the management, but they are not giving me. First I should ask the management why they are not giving me. And also here also I will consider reassessing my risk of material misstatement. Here also I will consider modifying my opinion. What kind of modification once again? Here also I will try to give disclaimer of opinion. So this is what SA 580 is talking about. Understood? How many standards we are done? 4 standards. What are they? 250, 501, 505, 580. How many more we are left with? 4 more standards we are left with. So now we will spend some time on understanding SA 510. So what is the title of SA 510? Initial audit engagements and opening balances. So first definitions, if you observe, initial audit engagement. What do you mean by initial audit engagement? What is the definition they give there? Initial audit engagement refers to that audit engagement where the previous years were not audited, or they are audited by some predecessor auditor. When I say predecessor auditor, what do I mean by that? Auditor from another firm. If in the same firm engagement partner is changing from year after year, then we don't call it as initial audit engagement. Altogether firm should have been replaced. Like for example, ABC and Co is there. For 1920 they are appointed as an auditor. Mr. A acted as an engagement partner. For 2021 also same firm ABC and Co, but Mr. B is acting as an engagement partner. Now tell me, for the year 2021 it will be an initial audit engagement or recurring audit? It will be recurring audit only. Why? Because the partner from the same firm is changing. But we say predecessor auditor or initial audit engagement when altogether auditor is different. Understood? So initial audit engagement refers to that audit engagements where the prior year's financial statements were unaudited, or even though they are audited by some predecessor auditor. Next, let us talk about opening balances. What do you mean by opening balances? These are those balances which are available at the beginning of the period, and these are nothing but last year's closing balances. And opening balances reflect 2 things: the effect of transactions which have happened during previous year, and also they reflect effect of accounting policies which you have followed. So 2 things they will reflect: effect of transactions which have happened, and also what accounting policies have been followed. So these are the definitions: initial audit engagement, predecessor auditor, opening balances. Now let us come to the objective of the standard. Why this standard has been given? What is the standard giving the guidance about? This standard says that particularly when you are doing initial audit engagement, when you are doing initial audit engagement, it is the auditor's responsibility to obtain sufficient and appropriate audit evidence whether opening balances contain material misstatement which is affecting the current year's closing balances also. At the same time, you should also obtain audit evidence, whatever accounting policies which are reflected in the opening balances, whether they are consistently applied or not. And because of valid reason, if they are changed, what should have happened? Proper disclosure should have been given. So I need to obtain evidence regarding these two matters. That is what the purpose of the standard. When you are doing initial audit engagements, we need to obtain evidence whether opening balances contain a misstatement which is going to affect my current year's closing balances. At the same time, try to obtain evidence whatever accounting policies which are reflected in the opening balances, whether they are consistently applied. If because of valid reason, if they are not consistently applied, try to check whether proper disclosures are given or not. So with this objective, they have given this standard. Why? Because if the opening, if you verified all the current year transactions, but if you don't verify opening balances, and if the opening balances contain a misstatement, even current year's closing balances are also going to get affected because of this. So that's why it is our responsibility to even check opening balances also. The importance is even more when we are doing initial audit engagement. Understood the objective, everybody? Now, if we have a look at audit procedures, sir, what audit procedures I am required to do regarding this opening balances? So first they say if the last year's financial statements are audited, try to get that last year's audited financial statements you try to get. And also while doing audit of the current years, you find out whether any evidence of the previous balances are found out. If I am doing current year, sometimes while doing the current year's audit, I might get the evidence regarding opening balances. Stay cautious whether this whatever procedures you have performed during the current year, have they given any evidence regarding opening balances. And also check whatever accounting policies that are reflected in the opening balances, are they appropriate? Like for example, from the depreciation, I came to know that company is following SLM method of charging depreciation. You tell me when SLM method will be more appropriate? When that particular asset is expected to be used uniformly throughout the year. But I came to know that year after year usage is going to get reduced. So what method should have been appropriate? WDV. But they followed what? SLR. So here, does the accounting policy which they follow, is it appropriate? No, it is not appropriate. So try to obtain evidence whatever accounting policies are there which are reflected in the opening balances, whether they are appropriate or not. Now you perform specific procedures like take the last year's audited financial statements, take the opening trial balance, check both whether they are matching or not. Whatever balances which are there in the opening trial balance, whether they are matching with my audited financial statements or not, you try to match the both. This is what specifically audit procedures I will do. Understood? So now after performing this audit procedures regarding opening balances, I might have some observations. See, if I came to know that opening balances are not containing any material misstatement, well and good, no problem, unmodified opinion you will give. If you came to know that opening balances contain a material misstatement that are affecting the current year's financial statements also, then what I am supposed to do? Modify my opinion. What kind of modification? Either a qualified opinion or adverse opinion depending on materiality and pervasiveness. Sometimes I will not be in a situation to obtain audit evidence whether opening balances contain a material misstatement or not. I am not in a situation to obtain audit evidence. Then also what I am supposed to do? Modify my opinion. Here what kind of modification? Either a qualified opinion or disclaimer of opinion I am supposed to give. Understood? Now, next one, same with the accounting policies also. So when it comes to accounting policies, here as I told, I need to check if last year's whatever accounting policies are there, whether they are consistently applied or not. And also whether if there is any change because of valid reason, there is a change in the accounting policy, but there is a valid reason for that. Then what I need to check? Proper disclosure is given. And if any of these things get violated, that means consistency not followed. There is no valid reason, just like that management changed the accounting policy. Or there is a valid reason, management changed the accounting policy, but they did not give disclosure. In both the circumstances, I need to modify my opinion. Two things I am telling, please pay attention to this carefully. Without any valid reason, consistently violated. Consistency is violated. If there is a valid reason, accounting policy is changed, but for that there is a what? Valid reason, but disclosure is not properly given. If there is a change in accounting policy, valid reason is there, proper disclosure is also given. No need to modify our opinion. When we will modify? There is no valid reason, accounting policy change, but proper disclosure is not given. In those circumstances, I will give a modified opinion. What kind of modified opinion? Either a qualified or adverse. See, here you should not come across a scenario of non-availability of audit evidence. Here there will not be a scenario of non-availability of audit evidence. Why there will not be a scenario? Why? Because being a chartered accountant, we must be in a position to state which accounting policy is correct, which accounting policy is not correct. If you say, sir, I am a chartered accountant, but I don't know whether this accounting policy is correct or not, then you don't deserve to be a chartered accountant. So you should be able to use your knowledge to decide in this given circumstance whether this accounting policy is correct or not. You have to, that's all. So that's why standard is not giving us any scenario regarding non-availability of audit evidence. One more last thing they will try to say regarding SA 510. What if there is a modified opinion in the predecessor auditor's report? If the last year auditor's report contains a modified opinion, are you required to modify your current year's opinion also? Not required. When we will modify? Because of whatever reason the last year's auditor gave modified opinion, if that reason remains valid in the current year, if that reason is material in the current year, if that is not even rectified in the current year, then only we will modify our opinion. If the last year auditor gave a modified opinion, but that reason for which he has given a modified opinion, it is no longer relevant in the current year. Either it is rectified or it is not material in the current year, still will we modify our opinion? No. So just because last year's auditor contains a modified opinion, there is no mandatory requirement on the current year's audit report also to be giving a modified opinion. We will modify only when that reason remains relevant, only when that reason remains material, only when that reason is not yet rectified in the current year. Then only we will modify. Just because of the fact last year's auditor contained modified opinion, we will also not modify our opinion. Clear and comfortable? Understood everybody? Shall we proceed further now? Right. So 5 standards we are done. We are left with 3 more standards. So now we will start about SA 570. So SA 570, very important standard. So when it comes to SA 570, what are the objectives of the standard? First of all, who is required to make an assessment regarding going concern? Management is required to make an assessment regarding going concern. What do you mean by going concern assumption? That the entity will continue for a foreseeable future. What is that foreseeable future? 12 months from the date of the balance sheet date. So first audit, it is a responsibility of the management to analyze and determine whether they have a capability to continue for the coming 12 months or not. That need to be decided by whom? Management. They have to do their analysis on the basis of their current working conditions, etc. And the management, while making that assessment, they need to keep some conditions. They need to consider some factors. So a heading will be there in our material: preliminary assessment regarding going concern done by management. So management is primarily responsible, and keeping what factors in mind, they will decide whether entity will continue in the future or not. It just don't depend on only management's intention. Like I went to the management and asked, sir, you want to continue for the future? They told us. Will that be enough for going concern to be valid? No. I need to check various other factors also. Like what? Nature and condition of the business. Right? And sometimes it could depend on impact of laws and regulations. Sometimes laws and regulations in the outside environment could change. That could even have an impact on my client's business. And even I need to consider what else are there. Have you opened the standard? External events or conditions. So sometimes entire industry might be going through the bad phase. That also has to be considered. And one more item. Operational forecast. You have to also even prepare a projection for the coming 1 year. That means you need to estimate what are your cash flows for the coming year, cash outflows for the coming 1 year, whether your outflows are lesser than the inflows or not. So you need to do this forecast projections you need to do, then you have to decide. So when I say management has to make an assessment regarding going concern, out of the air they will not say, sir, our going concern will be valid. So they will analyze these factors, then they will come to a conclusion whether going concern is valid or not. What are those factors? Nature and condition of business, external events, changes in the laws and regulations, or operational forecast. Now, if this is the management responsibility, then what is the auditor's responsibility as per SA 570? I need to determine whatever assumption management has made regarding going concern, whether it is valid or not. I need to obtain sufficient and appropriate audit evidence, whatever assessment regarding going concern management has made, whether that is valid or not. Like for example, if the management is telling, sir, our going concern assumption is valid. That is, sir, we will continue for the next 12 months. I will not blindly believe it. No, I need some sufficient and appropriate audit evidence that you need to obtain. If they say, no, sir, we will close down the business in the coming 1 year, then I need to determine whether really they want to close down the business or not. So whatever assessment management has made regarding going concern, whether it is valid or not, my responsibility is to obtain sufficient and appropriate audit evidence. And after this, on the basis of evidence which you have got, determine whether there is a material uncertainty related to going concern. First, I will check whether going concern is valid or not, whatever assessment management made valid or not. On the basis of that evidence, I will also determine what is there any material uncertainty regarding going concern. What do you mean by material uncertainty regarding going concern? As of now, neither the auditor nor the company are in a situation to comment whether we will continue or not. Why? Because it depends on some external factors beyond the control of the management and auditor. Like in the classroom example, I might have told you about, this situation has been faced by so many companies in that COVID lockdown times. So like especially hotel industry. So every hotel industry had some reserves with the existing cash balance. They were able to continue for the coming 6 months. They'll meet their expenses for the 6 months. If within that 6 months, if the COVID comes under control, lockdown restrictions are lifted up, then the entity will continue. If within the 6 months COVID cases does not come under control, lockdown is still not lifted, then it is highly doubtful whether entity will continue or not. So here that particular hotel, whether it will continue in the industry or not, it depends on COVID cases coming under control and lockdown being lifted up. Is this in the management's control? Is this in the auditor's control? No. So this situation we call it as what? Material uncertainty related to going concern. We don't know whether entity will be able to continue in the future or not. Why? Because it is highly uncertain depending on some factors beyond the control of the management. Right? So determine whether there is any material uncertainty. This is second objective. And the third objective of the standard is what? Report appropriately. Whatever your findings are there, that you need to report. Understood? So now, then what audit procedures you will perform? In order to, so we need to obtain sufficient and appropriate audit evidence, and when we want to obtain sufficient and appropriate audit evidence, we need to perform audit procedures. No, then only we will get the audit evidence. The magic will not happen and evidence will automatically come to you. So if your objective is to obtain sufficient and appropriate audit evidence, first we need to perform audit procedures. Sir, what are those audit procedures? We need not take the load that standard has only explained. SA 570 itself has given what audit procedures we need to perform. Then in this audit procedures also, they have divided audit procedures into two categories: risk assessment procedures, further audit procedures. So when it comes to risk assessment procedures, that is whenever you are understanding about the entity and its environment, at that point of time only you need to understand, is there any event or circumstance which create a doubt regarding entity's ability to continue as a going concern. At the time when we are performing risk assessment procedures, yesterday I have told you what do you mean by risk assessment procedure. That is where the time of understanding of the entity, its environment and its internal control. At the beginning of the audit only, you need to determine whether there is any event or circumstance which create a doubt regarding entity's ability to continue as a going concern. How can you do it? So how can you do it? By simply inquiring the management. So if the management has already made assessment regarding going concern, like I have told you the previous factors, no? After considering that factors, if the management has already made an assessment, you try to go and inquire the management, are they finding any difficulty for continuing the business? First I will go and inquire if the management prepared the assessment. What if the management is not making an assessment? Then I will go and question the management, sir, why you did not make the assessment till now? And if you have not made an assessment, how you are able to come to a conclusion going concern is valid? This is what you are supposed to do. So at the time when you are doing risk assessment procedures, first inquire the management. If they have already made an assessment, go and ask them, have they find out any events or circumstances that create a doubt regarding going concern? If they have not made an assessment, then what we are supposed to do? Then we have to ask the management, sir, why you did not make the assessment? Without making this analysis, how you are able to conclude that going concern is valid or invalid? Understood? So that you will do. Now by performing this risk assessment procedures, if I find any event or circumstance which create a doubt regarding going concern, then I will perform further audit procedures. If I don't find any event or circumstance which create a doubt regarding going concern, I will stop with risk assessment procedures only. I will not do further audit procedures. Understood? Risk assessment procedures I will do. By performing this risk assessment procedures, yes, I came to know that there are some factors which are creating a doubt regarding going concern. Then I will do what? Further audit procedures. If after performing risk assessment procedures, I don't find anything suspicious, everything is correct, then I need not perform further audit procedures. I can stop with risk assessment procedures only. So what are that further audit procedures? First, if the management has not made an assessment, ask the management to make an assessment now. And also ask the management whether they have prepared any cash flow forecast. If they prepare the cash flow forecast, etc., try to get that cash flow forecast. Check whether they have prepared that cash flow forecast on the basis of reliable data or not. Similarly, you can also go and understand about what are the management's plans for the future. If they are having a lot of outstandings payable, but they don't have inflows, go and ask the management, sir, your long-term borrowing is approaching, but you don't have enough of funds. What is the thing you are planning to do? If the management told, sir, you need not worry, we have alternative financing arrangement, they will say whatever they want, but we should not be blindly accepting. No, we are checking how far those management plans are feasible. And also we need to perform procedures like reading their interim financial statements, obtaining evidence regarding subsequent events, reading even their whatever board meetings which have happened after this, making an assessment of the going concern. So like that, even these additional procedures also I need to perform. So by performing all these further audit procedures, then you will come to a conclusion whether going concern is valid for this client or not. Understood, everybody? So on the basis of that observation, you have to consider modifying your opinion or giving an unmodified opinion. So you do risk assessment procedure, identify the risk of material misstatement regarding going concern. If there is a risk, then we will perform further audit procedures. On the basis of that further audit procedures, you will come to a conclusion. Now, based on that conclusion, we will consider our auditor's reporting. Understood the flow of process here? Now, so how this going concern observations are going to have an impact on our auditor's reporting? Very, very important discussion. So audit reporting and audit reporting impact because of going concern. See, after performing risk assessment procedures, further audit procedures, if I came to know that going concern is appropriate, what I will do? That means entity will continue for the foreseeable future. There is no doubt at all. What opinion I will give? Undoubtedly, I will give unmodified opinion. Why? Because there is nothing suspicious here. Everything is fine. The next scenario, going concern is inappropriate. What do you mean by going concern is inappropriate? That means it is clearly visible that entity will not continue for the next 1 year. Either management themselves want to liquidate the company, or I am able to see that the financial position of the company is very bad, that it is highly impossible for the company to continue in the future. I have a clear-cut evidence that going concern is inappropriate. Then what I am supposed to do? Here I need to check whether adequate disclosures are given in the financial statements. If adequate disclosure is given, what do I mean by adequate disclosure given? Adequate disclosure given means they have agreed that going concern is inappropriate. Management is not denying the fact. They told in the financial statements going concern is not valid for us. And we know that when the going concern is not valid, all the assets and liabilities should be valued at realizable value. That also management has done. They are not fighting with us. No, sir, going concern is valid. I will show the assets at historical cost only. They are not agreeing. Even in the financial statements, they have given a disclosure. Going concern is not valid for us. All the assets and liabilities they have valued at realizable value. That the differential value has been even taken to statement of P&L also. Everything has been given. So then what I will do? What opinion I will give? Unmodified opinion only. Why? Because here there is no misstatement. When the management deny the fact and try to present something else, then we call it as then we can say financial statements contain a misstatement. But here it is not a misstatement in the financial statement, so we'll give unmodified opinion. The next one, what if the adequate disclosure not given? What do you mean by adequate disclosure not given? That means going concern assumption is invalid. I asked the management, sir, going concern assumption is invalid. Please value all the assets and liabilities at realizable value. But still what the management is telling? No, we will continue to value our assets at historical cost only. So then what opinion you are supposed to give? The standard has directly told, go ahead and give a adverse opinion. Understood? Next comes the last scenario. What if there is a material uncertainty related to going concern? So what if there is a material uncertainty related to going concern? So if there is a material uncertainty regarding going concern, here also I need to check whether adequate disclosure given in the financial statements. So that means company is facing some uncertainty even beyond the control of the management. Without their fault, they have clearly explained in the notes to accounts, boss, we are having this material uncertainty. We don't know whether we will continue in the future or not. Management clearly told this information in the notes to accounts. What opinion I will give? Unmodified only give. But the standard will ask you to do one more thing here. What the standard will ask you to do? Okay, you have given unmodified opinion, but we can't expect the reader to go through entire financial statements and get this information. No. So it is better to highlight this information somewhere in the auditor's report. See, if they have not mentioned anything, we would have highlighted in emphasis. But the standard is not asking us not to highlight in the emphasis. It is asking us to make use of separate paragraph. Which paragraph? Material uncertainty related to going concern. So like this, use one paragraph with a separate heading and try to highlight that matter there. See, if they would not have told this material uncertainty, what we would have done? Emphasis we would have done. But since specifically, strictly they are asking us to use it in the material uncertainty separate paragraph, we will use that material uncertainty paragraph. And what if adequate disclosure not given? If adequate disclosure is not given, we will give what? Modified opinion. What kind of modification in? Either qualified or adverse opinion we are supposed to give. Understood? So this is how the going concern is going to have an impact on auditors reporting. Very, very important part is this reporting. Now, apart from that, the standard also say one more thing. What are those events or circumstances which created doubt regarding going concern? Like as we have took this name here, we perform risk assessment procedures to identify whether there are any events or circumstances that create a doubt regarding going concern. Sir, are there any examples of that events or circumstances which create a doubt regarding going concern? Yes, there are. The standard has identified. That too under 3 categories they have identified. What are they? Financial indicators, operating indicators, other indicators. Financial indicators like your borrowings are more than your assets, and also your long-term borrowings are approaching maturity without any means for repayment. You are continuously making losses. You are continuously having negative cash flows. So these are some financial indicators. When it comes to operating indicators, like management themselves want to liquidate, business difficulties like loss of major market share, or loss of your franchises, loss of key supplies, or labor difficulties. These are operating indicators. When it comes to other indicators, it is like non-compliance with the laws and regulations, pending cases going on against the company, and what is that? Changes in the laws and regulations. These are some other indicators. This is what will be mentioned on that SA 570. Clear about it? Right. So now we will start discussing about SA 560, which will be talking about subsequent events. So let us now quickly try to understand the subsequent events also. I thought in the first slot, 1.5 hours, I have to complete the standards. I think we are close to completion. We will do it. We'll do it, no? We'll do it. So some 5 minutes it might get extended. I don't think that also will be extended, but let us see. Okay, fine. So let us talk about now subsequent events. First, in order to understand subsequent events, we need to understand some definitions like date of financial statements, next date of approval of the financial statements, date of auditor's report, and date of issue of the financial statements. Date of financial statements, we already know. Date of balance sheet, 31st of March of the respective financial year. Date of approval of the financial statements, that date on which the people with the recognized authority acknowledge the responsibility for the financial statements. Nothing but in simple terms, the date on which board of directors sign the financial statements, that we call it as date of approval of financial statements. Next one, date of auditor's report. Nothing but the date which auditor mentions on auditor's report. And date of issue of financial statements, the date on which financial statements are made available to third parties. When I say third parties, other than auditor and management, and that date of issue can be sending the financial statements over email, or uploading that financial statements on the company's website, or sending that financial statements copy to the stock exchange, whatever it could be. In whatever means the financial statements are made available as to the third party, that date we call it as date of issue of financial statements. And what is the meaning of subsequent events as per SA 560? Those events which are happening between date of financial statements and date of auditor's report. Some event has happened between these two dates, and the auditor came to know about this fact after the date of auditor's report. An event which happened between the date of financial statements and the date of auditor's report, but the auditor came to know about it after the date of auditor's report. Those events we call them as what? Subsequent events. Even our accounting standards also will define subsequent events. Their subsequent events definition is a bit different. That refers to those events which happen between date of financial statements and the date of approval of financial statements. And they also classify them into two categories: subsequent events and adjusting events and non-adjusting events. Right? So now, with what objective this standard has been given? SA 560. This standard has been given with the objective that as an auditor, we should obtain sufficient and appropriate audit evidence, whatever events are there, whatever subsequent events are there, whether they are properly reflected in the financial statements or not. And also, what if you find anything, and also you need to perform some audit procedures to identify that subsequent events, and whatever your findings are there, that you are required to report according to the requirements of this standard. And what are those audit procedures which are required to be performed to identify the subsequent events? First, try to understand what policies management has implemented to identify the subsequent events. Then you try to perform procedures like try to read their prior period financial statements, try to read the interim financial statements like quarterly financial statements. Try to go through the minutes of the meetings which are happened after the date of approval of the financial statements, and also try to inquire with the management and those charged with governance, and even try to perform some procedures regarding going concern also. Going concern related procedures also will help you to identify subsequent events. So these are the audit procedures which you need to perform. And the next point is about what will be the auditor's responsibilities in case if you came to know about any subsequent event after the date of auditor's report, what you are supposed to do. So this we have divided into two circumstances. There could be two circumstances. What are they? Case 1, case 2. Case 1 refers to that circumstances auditor has come up to know about subsequent event before the issue of financial statements. What is case 2? Auditor came to know about subsequent event after the financial statements are issued to the common public. And in the case 1 also, I will say there are two more categories. Financial statements are not yet issued. In that also two things can be there. Audit report already delivered to the management. Audit report already delivered. That means you signed the audit report and gave it to the management. Other one is audit report not yet delivered. Right. See, generally they say that once you sign the audit report, you are not required to perform any audit procedures. But if you came to know about any circumstance, and if you are feeling that if I came to know about this circumstance at the time when I have given the audit report, I would have given a different opinion. If you came to know about such a information, then you are required to do this. So if audit report is not yet delivered, yes, favorable scenario, no need to be worried about. Why? Because audit report is still with us. When audit report is already delivered, here it is a problem. What I'm supposed to do here? Ask the management first not to circulate the auditor's report until the further notice. You should not be circulating it. So first give that instructions to the management. Then what I'm supposed to do is discuss with the management and those charged with governance. Discuss with the management. And as a part of that discussion, determine whether financial statements need amendment. So if the financial statements need amendment, ask the management how they want to address this issue. That means whether they are ready to amend the financial statements, whether they are not ready to amend the financial statements. If they amended the financial statements, first check whether they have made the amendment properly or not. They have amended the financial statements. What I'm supposed to check? Whether amendment done properly or not, try to obtain sufficient and appropriate audit evidence. Is there any requirement to modify my opinion now? No. So I will take back my audit report which I have given to them, give a new audit report without any modifying my opinion. So why? Because they have agreed to amend it. So here I will give unmodified opinion only. What if the management is not amending the financial statements? I find some subsequent event. It is an adjusting event. I asked the management, sir, you please have to update your financial statements. Management told, no, sir, we will not update our financial statements. Management is not ready to amend. Then what I will do? Then I will give modified opinion and ask the management to circulate this new audit report in which I have given a modified opinion. This is what you are supposed to do. And when it comes to second scenario, what if you came to know about subsequent events after the issue of financial statements? See, here also generally once the financial statements are issued, I am not required to do anything. But in case if I came to know about some event or circumstances, and if I believe that had I known this information before giving my opinion, I would have modified my opinion. If you got to know about such information, then you need to perform audit procedures. So if after the financial statements are already issued, then if you came to know about subsequent event, they simply say one thing. First, ask the management to take reasonable steps for stopping reliance on auditor's report. What could be the reasonable step? Giving a public notice or advertisement or communicating to exchange, uploading a news in the website. So whatever it is, ask the management to take appropriate steps to stop the reliance on auditor's report. If management did not take action, then who has to take action? Auditor himself has to take the action to stop the people from believing the auditor's report. Once that step is taken, once again what I will do? Discuss with the management, determine whether financial statements need amendment. If the financial statements need amendment, decide how the management wants to address this matter. If the management amends the financial statements, if the management has amended, check whether amendment has been done properly or not, try to obtain audit evidence. Now they say that since already financial statements are given, now financial statements are once again updated, no. So now you will give once again audit report, but the shareholders are already having one copy. Now you are sending one more copy of the financial statements. Now shareholders will get confused or not. What is the difference between previously issued financial statements and now issued financial statements? So that's why what the standard has told is to avoid the confusion in this scenario, or to exactly let the shareholder know what is the difference between the previously issued financial statements and the now given financial statements. Try to highlight the difference in either emphasis of matter paragraph or other matter paragraph. That is up to you what you want to use. Either you use emphasis or you use other matter paragraph. Why? Because shareholder will be having two sets of financial statements. He will be confused what is the difference. So if I try to highlight it somewhere in my audit report, the shareholder will be at better understanding what is the difference. And what if the management do not agree to amend the financial statements? What if they do not amend? So now I will give a modified opinion, new audit report I will give, and I will ask the management to circulate this new audit report to the shareholders which contains a modified opinion. Understood? So these will be the auditor's responsibilities in the case of subsequent events as per SA 560. Understood? Right. So now we are left with only one more standard. We are also left with 10 more minutes. Good. Right. So SA 220. What does this SA 220 deal about? Quality control in an audit of the financial statements. Nothing but this standard has been exclusively given for protecting the quality. Whenever we are providing audit services to our clients, we should not be doing the audit in such a manner that where we are compromising on the quality of the audit, we should do the audit in a qualitative manner. So to help us out in maintaining that quality of the auditor's work, this SA 220 has been released. And what this standard says is, in order to maintain quality in the auditor's work, we need to have some policies and procedures. In order to maintain quality in the auditor's work, what we are supposed to have? We need to have some policies and procedures. And that policies and procedures should be there in 6 areas. How many areas? 6 areas. If you want to maintain quality, we need to follow some policies and procedures. And that policies and procedures should be followed in how many areas? 6 areas related to audit. First one is leadership responsibility regarding the quality control. In this area, I need to have some policies and procedures. Second one, acceptance and continuance of client relationship. Regarding this area, we need to have some policies. Next one, ethical requirements. After that, human resources, then engagement performance, and after that, last one, monitoring of the policies and procedures. So now what the standard is telling is, if you want to have quality, then you need to have policies and procedures in these 6 areas. So let us try to address each area at a time. Like first one, they are talking about leadership responsibility. So if you want to maintain quality in an audit, you cannot make all the people collectively responsible. For example, this one simple example I will say, like if I make this entire class of people collectively responsible for one work, huge chances that that work will not happen at all. Yes or no? Why? Because I am making collectively responsible. When I make a group of people collectively responsible, they can simply play the blame game. They will say, sir, why are you asking me? Why you don't ask other people? Why? When I go to other person, he will also say the same thing. Why are you coming and asking me? Why do you have that grudge on me? Why don't you talk? Why don't you ask others? So these kind of questions I will get. So when I make a group of people collectively responsible for certain activities, there are high chances that that work will not happen at all. So if instead of that, if I give 1 or 2% leadership responsibility, hey boss, you are responsible. You have to ensure that rest of the people do this work. Then there are more chances for achieving that objective or not. Same thing applies in the audit also. If you want to maintain quality in the audit work, don't make entire engagement team collectively responsible. Give someone a leadership responsibility for maintaining quality. And you tell me who should be given that leadership responsibility? Engagement partner. SA 220 also says the same thing. There is a logic also why engagement partner has to take the leadership responsibility. Why? Because if tomorrow something goes wrong, you have to go and sit behind the bars. So that's why it is better you only take leadership responsibility. So the standard says that as an engagement partner, we need to take the leadership responsibility for maintaining the quality. That means in taking that leadership responsibility, we should try to highlight our engagement team members how important the quality is, how important it is to do the work as per professional standards, how important it is to do the work as per laws and regulations, how important it is to give the audit report appropriate in the circumstances, either by way of my actions or either by way of my communication. I should always try to highlight this information to my engagement team members. So this is what the leadership responsibility. Second one, acceptance and continuance of client relationship. This we have already covered it as a part of our nature, objective and scope of audit. 4 factors we need to consider before accepting and continuing client relationship. Like yesterday only we have seen integrity of the management, ethical requirements, competence of the engagement team members, significant matters have arisen during previous audit. Ethical requirements, this also we have covered. So 5 ethical requirements. What are they? Integrity, objectivity, confidentiality, professional skepticism and due care, professional behavior. These 5 ethical requirements. And next comes human resources. That means if you want to ensure quality in the audit work, you need to have proper staff. Human resources means nothing but what you are personal, your staff. So like I need to implement some policies and procedures with regard to my staff. Like if my staff is not having enough of training, I need to provide them training. If they are getting stuck somewhere, I need to provide them guidance. I need to provide some scope for their career development. If I need to do their performance evaluation, if I find someone doing the good job, I need to compensate him well. And also I need to promote him. So these kind of, and even I should try to address their personal needs also. And at the time of recruiting, I should select only those people who are ready to update and develop their skills for doing the relevant audit. So when your staff are more suitable, more competent, more knowledgeable, more skillful, my audit will be done in a better quality. Understood? So these kind of policies you should have regarding human resources. Next one is engagement performance. Nothing but at the time when the engagement is getting performed, whether it is done in a qualitative manner or not, here some steps I have to take. Like as an auditor, I should brief my engagement team members what and all should be covered in this audit. I should create such an environment that where a person should come and ask his doubts without any fear or concern. I should give them such an instructions that they will do the work as per professional standards, as per legal and regulatory requirements. They will give appropriate opinions. And finally, having this policies in all the areas alone is not enough. We need to even do what? Monitoring also. When I say monitoring, I need to review whatever policies I have implemented till now in different areas, whether they are really getting implemented or they are not getting implemented. If any change is required to be made, if any policies need to be scrapped and in its place new policy has to be implemented, if any policy has to be changed, this continuous monitoring also should happen. Understood? That is what the last aspect, monitoring, is about. So in order to maintain the quality in an audit, the standard SA 220 is asking to implement us policies and procedures in these 6 different areas. Clear everybody? Right. We are done with all the 8 standards for classroom discussion. So we will leave for a break now. We'll once again meet at sharp 11 o'clock, and we will take up in the 11 o'clock session. What we will take it up? A risk assessment and internal control we will start. So in the next 1.5 hours, I will try to complete risk assessment and internal control, and along with that I will try to complete fraud and responsibilities of auditor also. This is what I am trying to do it. Let us see how far the things will go. Right. Okay, shall we start? Fine. So we'll be taking up now the chapter risk assessment and internal control. And the relevant standard which we are going to cover here is SA 315. So this entire chapter has been taken from the concept of SA 315. So first we will start with the topic of risk assessment. So in order to understand this risk assessment, first we need to analyze the concept of audit risk. Sir, what do you mean by the term audit risk? The meaning of the term audit risk is risk of expressing an inappropriate opinion when the financial statements are materially misstated. That means when the financial statements contain a material misstatement, and in such a circumstance, if you are giving an inappropriate opinion, that only will come under audit risk. Like for example, financial statements are containing a material misstatement. You are supposed to give what opinion? Modified opinion. That modification could be either qualified, adverse, disclaimer. So you are supposed to give modified opinion. This is the appropriate opinion. But you, instead of that, you are giving inappropriate opinion. That means what could be the inappropriate opinion here? You are giving unmodified opinion. So this we call it as what? Audit risk. That means you are giving a unmodified opinion which is actually inappropriate opinion, when actually which opinion is appropriate? Modified opinion. So if you give this, you have to face the legal consequences tomorrow if you are not able to find out the mistake. And if that mistake is there, is there, will there be any problem in the online mode? Okay, don't make noise. I think online people will not face any trouble. It's running seamlessly. I think we can continue here. The screen is visible. I am visible. What else you need? Right. Okay. So let us continue now. So the financial statements contain material misstatements. You are supposed to give modified opinion, but instead of that, you give a unmodified opinion. This we call it as what? Audit risk. Why? Because if this misstatement is there in the news in the public domain, definitely regulatory authorities are going to question you. Boss, you did the audit of that respective financial year, but still you are not able to identify a misstatement. Why you are not able to identify a misstatement? And it all depends whether you will be able to prove, not prove. So all these things will be there. So anyhow, you have to face the risk. Whereas assume that financial statements are not containing a material misstatements. Financial statements are what? Not containing a material misstatement. If the financial statements are not containing a material misstatement, what could be the appropriate opinion here? Unmodified opinion could be appropriate here. But instead of giving unmodified opinion, you are giving a modified opinion. When I say modified, it could be either qualified, adverse, disclaimer. Which opinion is appropriate? Unmodified. But what opinion you are giving? Modified. Will this come under audit risk? This will not come under audit risk. So if you go by the definition, it covers only one thing: giving an inappropriate opinion when the financial statements contain a material misstatement, and even more simpler terms, giving a unmodified opinion when modified opinion is appropriate. This only will come under audit risk, but not the other way around. And also they say one more thing here: audit risk doesn't include even business risks of the auditor also, like loss of reputation, loss of clients, and you are not able to recover the fees from the clients. You are facing a bad reputation in the society. So all these are what? Business risk. They will not come under audit risk. Next, this audit risk is made up of so many components. Broadly, two components are there for that audit risk. One is risk of material misstatement, and other one is detection risk. Now, what is this risk of material misstatement? The risk of material misstatement simply means the possibility of happening a mistake in the financial statements prior to audit. That means even before you started the audit, the management, while preparing the financial statements only, they might have committed a mistake. They might have shown wrong amounts, wrong position in the financial statements. So that risk, we call it as what? Risk of material misstatement. It is purely management created risk. Auditor will not create this risk. What auditor can only do? He can only identify this risk. That too by doing what? Risk assessment procedures. So auditor will not be responsible for creating this risk of material misstatement. What is his responsibility? Only to identify, only to find it out. That too by performing what? Risk assessment procedures. Understood? So this is regarding risk of material misstatement. And this risk of material misstatement is further containing two more components. One is inherent risk and other one is control risk. When it comes to inherent risk, simply we call it as absence of internal control. That means a mistake is happening in the organization, and to protect that mistake, there is no internal control to protect it. That absence of internal control, we call it as what? Inherent risk. And when it comes to control risk, it is simply, I call it as failure of internal control. That means internal control is there, designed by the management, implemented by the management, but even after having the internal control also, still a mistake happened. That means internal control failed there. Internal control failed to prevent, correct or detect a misstatement on a timely manner. So that's why we call this as what? Control risk. Both inherent risk and control risk, both make up this risk of material misstatement, which is a management oriented risk. Now the next thing comes detection risk. So what do you mean by detection risk? Detection risk is purely associated with the auditor. It is a risk that whatever audit procedures performed by the auditor may not be able to detect a material misstatement which is already there in financial statements. There is a mistake in the financial statements. Generally, we do audit procedures to identify it. But after doing the audit procedures also, the auditor is not able to identify. So that risk we call it as what? Detection risk. Between the risk of material misstatement and detection risk, which one will be in the auditor's control? Detection risk. Which risk he can reduce? Detection risk only. What he can do with regard to risk of material misstatement? He can only identify it. So he will identify risk of material misstatement. On the basis of that, he will plan his audit procedures in such a way that his detection risk is managed, so that overall audit risk will be at a very low level. This is what completely happens in the audit. And also these components of audit risk are interrelated with each other. Both are related with each other. So how they are both related? Both are having what relationship? Inverse relationship they are having. That means if the auditor identifies high risk of material misstatement, he will try to perform more audit procedures. By performing more audit procedures, more mistakes will be detected. Detecting more mistakes. That means the detection risk is actually low here. On the other hand, if the risk of material misstatement is low, auditor will try to perform less audit procedures. If you perform less audit procedures, less misstatements will be detected. That means detection risk is going to be higher there. So there is going to be an inverse relationship between risk of material misstatement and detection risk. Now, this is what they will try to address in that question number 1 of risk assessment and internal control. Now, next question if we talk about, they will ask us to explain about risk assessment procedures in light of essay 315. We have already seen the basic meaning. Here they will try to elaborate this further. So in the risk assessment procedure, what is our objective of doing risk assessment procedure? To identify risk of material misstatement. And the standard says that this risk of material misstatement should be identified at 2 levels. One is at financial statement level and other one is at assertion level. Financial statement level risk means that risk which is going to have an impact on entire financial statements. Like the management is not having proper knowledge to prepare the financial statements, or management is not having integrity. Our accounting system is completely wrong. So these are some factors because of which not just 1 or 2 area will be misstated. What will be misstated? Entire financial statements could be misstated. So that kind of risk, what we call them? Financial statement level risk. Whereas assertion level risk means this risk will cause a misstatement only in a few specific areas. Like for example, when the warehouse controls are not strong, this would cause a misstatement where? Only in the inventory related area. Or similarly, this employee access, that biometric scanning is not working. So that could cause only in one specific area. So like that, if the risk is expected to cause a misstatement in only 1 or 2 specific areas, that risk we call it as what? Risk of material misstatement at the financial statement level. So, sorry, assertion level. So whatever it is, as an auditor, we need to identify risk of material misstatement at this 2 levels. After I identify the risk, the next step is to assess that risk. That means to analyze the risk, whether it is significant or not significant. And after analyzing this risk, I need to properly plan my audit procedures. Nature, timing, and extent of audit procedures should be properly planned in such a manner that my overall audit risk will be kept at a very low level. So this is what the objective of the standard: to identify, to assess, and on the basis of that properly plan your nature, timing, and extent of audit procedures to keep your audit risk at a very low level. And how I am going to do this identification, assessment, or deciding on audit procedures? Through understanding entity, its environment, and its internal controls. Understood? So now this is some significant statements here. So when you have some important statements here, this one, F point and G point, they are significantly very important. So let me tell you what they are trying to say. Also, the risk assessment do not provide sufficient and appropriate audit evidence on their own. See, by performing risk assessment procedures, we will never be able to get evidence. What is the outcome of risk assessment procedure? Only we will come to know about where the risk is higher, where the risk is lower. You are not going to get any evidence. So we will not get evidence by only performing risk assessment procedures. We will just come to know about where is the risk, where is there is no risk. And also they say one more statement in the next line: the assessment of risk is a matter capable of professional judgment, not a matter capable of precise measurement. That means we cannot exactly measure how much risk is there in each area. What we can only do, we can estimate it using our professional judgment. So that statement is also very important for true or false statements. They will ask you a question something like this: assessment of risk is a matter capable of precise measurement rather than a matter capable of professional judgment. Do you agree with that statement? No. They have told it in a reverse manner. So assessment of risk is a matter of professional judgment rather than a matter capable of precise measurement. We can't exactly measure the risk. Clear about it? Now, what will be included in the risk assessment procedure? That means how you can get to know about this entity, its environment, and its internal control, how you will get to identify and assess this risks of material misstatement. They say we can do some techniques, like first one they say inquiries, and other one we can do analytical procedures, and finally we can do even inspection and observations also. When it comes to inquiry, with whom and all you can inquire? Generally we can do with management, but management are not the only people from whom I can inquire. I can inquire with other persons like those charged with governance to know in what environment financial statements are prepared. If there is an internal audit team, I can go and discuss with internal audit team. If there is a legal counsel, I can go and inquire with them. If there is a sales and marketing team, I can go and inquire with them. And even if there is a risk management function, I can inquire with them. I can inquire with low level employees of the company. So when I say inquiry, you need not always inquire only with the management. You can inquire with so many other people in the organization also. That list will be given there. Then analytical procedures, as we know, even by studying the relationship between financial and non-financial information also, we can come to know whether the financial statements contain any risk of material misstatement. And when it comes to inspection and observation, we are going to inspect the client's premises, which we call it as a plant visit, and we can observe activities which are happening inside the organization. We can inspect and read their documents like incorporation documents, standard operating procedures, internal control manuals, that I can read, and even I can read their MOA, AOA, these kind of documents also can be inspected. So by doing inspection and observation also, I am going to get a significant amount of evidence. Clear about it? So this is what will be included in the risk assessment procedures: 3 activities: inquiries, analytical procedures, and inspection and observation. So now one more question, one more aspect will be there regarding this understanding of the entity. Not able to remember what is that. So understanding an entity is a continuous process. That means if you understand about the organization, it is not just like at the beginning of the audit we will do it and we will leave it. It is a continuous process, which means throughout the audit we will not be doing only understanding of the entity. What does that sentence mean is, at the beginning of the audit we will try to understand about our client, but throughout the audit we will remain cautious. We will remain alert for any updated information, so that if we get the updated information, we will change our understanding and accordingly we will make the changes to our systems. And then they say what will be the advantages. If you understand about the client's business, what advantages you will get. So as we know that we will come to identify what are risky areas. We will able to decide our audit procedures in a much effective manner. We'll be able to betterly plan our timing, where we need to spend more time, where we need to spend less time, and it will ultimately lead to the overall benefit of our audit. Our audit will be done in a much more effective manner. So like that, some advantages they will try to say that by performing this, by understanding this entity and its environment. So these four are the questions or aspects which are related to this risk assessment part. Now we will have a next part starting about internal control. So let us understand about concepts relating to internal control. So when we say internal control, we know that internal controls are policies or procedures which are designed, implemented and also maintained by whom? Management or those charged with governance or others. When I say others, will the auditor be included here? No, auditor will not design. When I say others, it will be like some outside consultant helping the management for designing and implementing internal controls. So, but broadly speaking, the main objective of the internal control is to prevent the mistakes. But specifically speaking, the objectives can be classified into four categories. What are the four specific objectives? First one, they say reliability of financial reporting. That means if you have internal controls in place, your financial statements will become more reliable, more trustable. Why? Because internal control ensure that amount is recorded in the correct account, amount is recorded at the correct amount is recorded in the correct heading. So all these things will be ensured by the internal control. The next major objective why it will be done is safeguarding of the assets, assets to protect the entity's assets, like having a CCTV camera, protecting the assets, physical counting of the inventory, protecting that respective asset. So like and having a cashier separately, accountant separately, protecting that asset. So safeguarding of the assets is another objective why majority of the internal controls will be implemented. And apart from that, we will also have some internal controls with the objective of increasing efficiency and effectiveness of operations, like restricting the employees' access to the internet. If you give them unrestricted access, their efficiency and effectiveness will be affected. So that's why companies will generally follow a policy of restricting the employees' access to the internal control, to the internet. That is also an internal control whose objective is increasing the efficiency and effectiveness of operations. And some internal controls will be implemented exclusively with the objective of compliance with laws and regulations. So broadly speaking, any internal control you take, it will be having either one or more of this specific objectives. Now there will be one more term called internal financial control. What we have seen is internal control. There will be one more term called internal financial controls. I think I have already mentioned this somewhere. What is the difference between internal financial controls and internal controls? Internal financial controls are also part of internal controls only, but whose objective is directly related to financial reporting. So internal financial controls definition also more or less will remain same. Why? Because internal financial controls are nothing but what? Part of internal controls only. So even if you read the definition of internal controls also, it will be something like this only. There also they will say reliability of financial reporting. There also they will say safeguarding of the assets. There also they will say compliance, and they will say timely preparation of financial statements. And instead of this efficiency and effectiveness of operations, they will use the term prevention of frauds and errors, prevention and detection of frauds and errors. So more or less the definitions of internal financial controls and internal controls both are same. And you can write one combined answer also. Like anyhow 3 points are common: reliability of financial reporting, safeguarding of the assets, and also compliance with the laws and regulations. Remember the next 2 points also: prevention of frauds and errors, efficiency and effectiveness of operations. Remember 5 points. If they ask you internal controls, write the same answer. If they ask you internal financial controls, then also write the same answer. So this is what the discussion regarding internal financial control. And also we have some reporting requirements for internal financial controls. Where we have reporting requirements? 143 subsection 3 clause I, which says I need to check whether my client is having proper internal financial controls and whether they are operating effectively or not. Understood? Right. So now let us talk about one more important aspect. See, if you have a well-designed internal controls in place, can they give a guarantee that entity's objectives will be achieved? If you have a sound internal control system in place, can it give a guarantee that whatever my objectives are there, that will be achieved? Like if you have CCTV camera, does it give a guarantee that no asset will be stolen? No. Why? Because no matter how effectively the internal controls are designed and implemented, even internal controls also can give you only reasonable assurance regarding achieving their objectives. Like the way audit can give reasonable assurance regarding true and fair view of financial statements, even internal controls will also give reasonable assurance only regarding the achievement of objectives. Why? Because like audit, internal controls are also suffering from some inherent limitations of internal control. Sir, what are that inherent limitations of internal control? So they try to say here, the first thing, human error in decision making. So we all know that this internal controls will be designed using the human being's professional judgment, and we even know that the humans will have a limited thinking power. They can only design internal control till the extent they can imagine. Sometimes always beyond the users, that individual's imagination could happen, which can make the internal control to go lapsed. And also sometimes there can be an error in the decision making, and which will cause the internal control to fail altogether. So human error in decision making, that is one main inherent limitation. Next one, next something they say, lack of understanding of the purpose. So sometimes even the employees who are required to implement this internal control, they might not understand the basic purpose of that internal control. That could also make the internal control to fail. Like for example, when you go to the supermarket for shopping, when you are done with the shopping and when you got your items billed, when you come out of the premises, that security guard is required to check. So what is the purpose of that security guard? He needs to check that whatever items are getting taken out, whether they are billed or not, he need to check. That means he need to check whatever items that are there in the trolley, whether they are in the bill or not. First he should look at some random items in the trolley, he should check whether it is there in the bill or not. But the security guard did not understand the purpose. He understood only one thing, items in the trolley, items in the bill, both should match. Now how he started looking is, he will look the items in the bill, then he will see whether they are in the trolley or not. He is doing checking only, but his approach is wrong here. What should be the correct approach? He should look at items in the trolley, whether they are in the bill or not. But what our security guard is doing, he is looking the items in the bill, checking whether they are trolley or not. They will be there. Why? Because that security guard is not understanding the purpose. His purpose of getting appointed is to ensure that items should not go out without getting billed. That he did not understand. He understood only one thing, both items should match. Since he did not understand the purpose, because of that also internal control could fail miserably. So that lack of understanding the purpose also could be one inherent limitation which internal control can suffer from. Next, what else? Collusion among the individuals. See, even individuals might collude with each other. Earlier, cashier and accountant, both responsibilities used to be played by one single user, and that person has committed lot of frauds. Now what management did is, cashier, accountant, both the responsibilities they have segregated. That cashier will only make payments and receipts. Accountant has to pass accounting entries. Now what could happen is, this both people can collude with each other. Accountant and cashier, they are discussing among themselves and they are telling, let us try to commit some fraud. Let us share the proceeds with each other. This collusion can always happen, which can cause the internal control to fail. And sometimes, since management will have complete control over the organization, sometimes they intentionally override the controls for their own benefits, like entering into side agreements, etc. Next one, cost exceeding benefits. So that means implementing internal controls is not going to be a simple affair. It is going to involve a lot of cost in the form of human resources, systems, resources, etc. So what some companies will do is, they will design the internal control, but they will not implement it effectively. So why? Because of the increased cost. So when you don't effectively implement it, that will also cause the internal control to fail. And one more last thing they say, limitations in the case of small entities. What they try to communicate here is, in the case of small entities, you will not have so many resources as you want. At the same time, you cannot have so much of time or at the same time, even owner will have control over entire organization. So this will limit the opportunities for segregation of duties and also for implementing internal control. That means what they simply want to communicate is, in the case of small organization, there are more chances for overriding the internal control. We have to keep this in mind while conducting the audit of a small entity. So these are the inherent limitations which the system of internal controls are suffering from. Understood? So let us see what else are there, what else significant concepts are there. So 4 we are done, 6 we are done. Right, controls relevant to the audit. See, an organization will have so many internal controls. Do you think each and every internal control should be considered by the auditor? Should he try to check and obtain evidence regarding each and every internal control? The answer is no. You need not try to obtain evidence regarding each and every internal control. So whether a control will be relevant or not, it depends on so many factors like its materiality, significance of the related risk, size of the entity, how many diversified operations you are having. So like that, various factors will be there. Keeping all these factors in mind, auditor will decide which control he has to be bothered with, which control he need not be bothered. Like one simple example, employees access to the internet is restricted. It is internal control. But do you think auditor will be concerned about this internal control also? Will he go and check whether employees will be able to access all the websites or restriction is there? Do you think statutory auditor will go and check it? No. It is an internal control, agreed. But this internal control is not relevant for auditor. And if internal control is not relevant for you, you need not verify it. You can simply skip it or ignore it. And even they say some example of airline system of internal controls also. Like flight scheduling will happen automatically on the basis of internal controls. This internal control will be there, but this might not be concerned to the auditor because of its not related nature to the financial statements. So this is what they try to say regarding internal controls relevant or not relevant to the auditor. So next, if we have a look at the next few important questions, see question number 8 is a very general question. What benefits will be there and why you have to understand. So very general information they try to say there. Why? Because if I don't understand the internal controls, my planning will be completely wrong. I will not be able to properly decide my program. And similarly, if you understand internal controls, then only you will come to know which area should be given top priority, which area should be given less priority. And also, if you don't study the internal control and develop a plan, it will be highly impossible for you to control the audit when you, it is highly impossible for you to keep the audit in your control. And also, how you can get to know about this information regarding internal control? As we have seen, by doing inquiries, inspection, observation and analytical procedures. And next important statement, point number E, existence of internal control is not an absolute deterrent to fraud. What does that sentence mean? That means even if we have a strong internal control system, there is no guarantee that fraud will not happen. Why? What is the logic for that? Just now we have seen. Why? Because it is suffering from inherent limitations. The next two statements, very important for true or false statements. So what they try to say here is, although most of the controls which are relevant to audit are related to financial reporting, but all the controls which are related to financial reporting might not be relevant for auditor. So if I have to put it in simple lines, all the controls which are related to financial reporting may or may not be relevant for auditor. Like for example, in the scrap, company is generating a scrap value. In the scrap, there is no proper internal control system. But that scrap is constituting that scrap sale is constituting only some 0.001% of the entire revenue. Agreed, internal control is related to financial reporting, sale of scrap. But do you think will you be considering it for audit also? No. Why? Because even that if internal control fails, the financial statements impact will be very, very less. So that's what they try to say here. All the controls which are related to financial reporting might not be relevant to auditor. This statement can be tested in the true or false statements. Try to get the underlying conceptual clarity so that even that twist you in any number of ways, we should be able to comfortably answer it. Understood? Clear everybody? Right. And benefits, if you understand internal control, what benefits will be there? We will know whether internal controls are working properly or not, whether internal audit department is functioning effectively or not, whether the entity's assets are properly protected, whether management is discharging their functions regarding the preparation of financial statements properly, and you will come to know where you have to spend more in-depth audit procedures, where you have to perform less in-depth audit procedures, and also you will come to know where controls are weak. Even you can give a suggestions for improvement of the internal controls also. So these are all point-wise information. No underlying concept is actually involved here. Now next comes the important topic, which is about methods for evaluation of internal control. When you want to understand about internal control, what methods are available for your evaluation of internal control? They say, broadly speaking, 4 methods are available. One is narrative record. Next one is internal control questionnaire. Next one, checklist. And the final one, flowchart. Important discussion. So First, we will talk about narrative record and flowchart. So narrative record means in this what will simply happen is the auditor will first try to understand what internal controls are doing, what is involved in the internal control. Then whatever understanding he had, that he will try to develop a exhaustive record. What he will try to do? He will develop a what? Exhaustive record. When I say exhaustive record, in a detailed paragraphical format, he will write it down, whatever he has observed in the internal control. And in the flow chart, what will happen in the flow chart? Here also, auditor will try to understand about internal controls, get a in-depth understanding. He will also try to document it, not in a exhaustive paragraphical manner. He will try to present it in a diagrammatical representation. That we call it as flow chart. Between narrative record and flow chart, which one is very time consuming? Narrative record is very time consuming. Why? Because first we need to understand, then we need to develop a complete record. Which one is brief or very concise? Flow chart. Which one will give us a better view of entire internal control? Flow chart. And also this narrative record, where it is suitable for big organizations or small organizations? For small organizations it will be suitable. We can't do this narrative record for big companies. Why? Because significant time will be consumed there. Now let us talk about internal control and checklist. Both are very widely used methods for evaluation of internal control. Both this internal control questionnaire and checklist, both are going to contain series of questions. Series of questions regarding what? Elements of the internal control. And how the questions will be drafted? In such a manner that the answer will be yes, no or not applicable. If you want, even you can add a additional remark for additional column for remarks also. And also they say one general instruction in the case of internal control questionnaire, try to draft the questions in such a manner that yes indicates a satisfactory answer, no indicates a non-satisfactory answer. Try to draft the questions in this manner. Now, so if both are containing series of questions, if both are containing questions in the format of yes, no or not applicable, and if both are drafted in the similar manner, then what is the difference between the two? In the case of internal control questionnaire, the questions will be answered by client's management or client's staff. Whereas when it comes to checklist, the questions will be answered by my own auditor staff. So it will be either in the form of instructions or questions to be answered by my own staff. Whereas in the case of evaluation, in the case of internal control questionnaire, I will prepare the questions, give it to the management. Either I will expect answers from the management or the client's employees. And also by way of these responses, whatever lapses I have found in the internal control, all the lapses will be reported to the management in a separate letter, which we call it as letter of weakness. So in that letter of weakness, I am going to report to the management whatever weaknesses or whatever lapses I have found in the system of internal control. So these are the four broadly used methods for evaluation of internal controls. Understood? Next one. So if you pay attention at the next questions, so methods of evaluation we are done. After that, this thing this is a general question we will see at the end. So let us first concentrate on the conceptual. So why you are going to perform test of control? Why we will perform test of control? Because we want to know whether internal controls are properly designed, whether they are able to prevent or correct a misstatement on a timely manner, and also we will see whether they are continuously working throughout the year or not. And out of the 7 techniques available for performing audit procedures, which techniques will be suitable for performing for testing internal controls? Inspection. We can do the checking of the supporting documents. We can do inquiries. We can even do reperformance, and even we can see inquiries also include observation also. 4 things they say here: inquiries, inspection, observation, reperformance. Along with that, today all the controls are getting implemented in the system. We will check whether there are proper internal controls operating over computer systems also or not. I need to check. That is what the last point is about: testing of internal controls operating on computerized applications. Why? Because today internal controls are getting implemented through system. If the systems are properly protected, even that internal controls also will work seamlessly. If the systems themselves are not protected, we cannot expect the internal controls in that systems to work effectively. Clear, everybody? Next. So, and a few more things. Internal financial controls I have covered. So now let me try to cover what are the components of internal control. See, any control you take, if you want to implement an internal control in the organization, it involves implementation through 5 steps or 5 components. So what are that 5 components? Means control environment, then entities risk assessment process, then we need to information systems including business process, then we need to do control activities, and finally after that monitoring. So any internal control you take, the implementation of any internal control has to take up this 5 components. What are those 5 components? Control environment, entities risk assessment process, information system including business process, control activities, monitoring of the controls. Now, so what actually happens in the control environment? Control environment means nothing but creating a good culture of honesty and ethical behavior. If you want the internal controls in the organization to work effectively, you need to first create a good culture. Like you should always communicate how important it is to do the work with ethical requirements. You should let them know how important it is to maintain integrity or honesty. And also you should not just communicate, you should even put into action also. If you find any person committing something wrong, you should not spare him. You should have removed him from the company immediately. And also it depends on how you are recruiting the people. At the time when you are recruiting the people, you should look for that people who are having commitments for developing the competence levels. And also when I say those charged with garners, they should not be like sitting in their separate cabins and enjoying that environment. The more they have to involve in the business, they should frequently ask the questions from the management. They have to check whether the employees are working properly or not. Then a good culture will be created. Similarly, if you take it depends on management's philosophy and also risk taking. Some managements are very honest people. So whenever they face any risk, they will immediately try to communicate, and they will also tell how they are going to address the risk. This is a very good attitude. Some other kinds of management will be there. Whenever they face any risk, they will not communicate, they will hide it, they will not let anybody know about it. This is a bad management. And similarly, what attitude management is having towards financial reporting process. Like for example, if the management is having attitude like whether I am showing profit or loss, it is irrelevant. I have to always show correct information. This is good attitude, which leads to good culture. On the other hand, if the management is telling whether I am showing correctly or not, I am least bothered, my financial statements always should show profit, that will create a bad culture in the organization. So like this, by taking these various steps, first a good control environment should be created, a good culture should be created, a culture of honesty and ethical behavior. After that, see, we are implementing internal control to prevent the mistakes only. First, I need to understand where there is a possibility of happening a misstatement. No. My objective of internal controls is what? To prevent mistakes from happening. If I want to prevent the mistakes from happening, first I need to know in my organization where there is a possibility of happening a misstatement. So first management need to identify where there is a risk in the organization. That is the next step. That is entities risk assessment process. Next one, they say information system including business resources, which means nothing but first we need implementation of internal controls requires us lot of resources. That could be human resources, labor resources, or material resources. I need to procure all that resources. That stage I call it as information system including business process. Now once I procure all the resources, once I procure all the people, once I procure all the systems, will it be enough or I need to actually implement that? I need to actually implement that. That means put all these resources into action. This stage I call it as control activities, which means actual implementation of internal control. And after you have implemented the internal controls, will your responsibility will come to an end with that? No. Whatever controls that I have implemented, whether they are working properly, whether they are working effectively, is there any requirement to be made to change to these systems? This continuous monitoring also should happen, and wherever required, even changes also should be made. So this last step we call it as what? Monitoring of the controls. Understood? So whenever you are implementing any internal control, you have to take care of this 5 steps. Control environment, doing a risk assessment of the entity, information system including business resources. You should also put all the resources into action, control activities, and after implementing that, you need to even monitor the controls also, how far they are effectively functioning. Clear and comfortable? Shall we proceed further? Right. So now few more things in between, some conceptual things will be there. So let me try to address that also. Why? Because from these things, they might ask you some conceptual true or false statements. So that I will try to cover. So one thing which we have to say is this question number 10, nothing but they say that we need to test internal controls. If you want to know whether internal controls is working properly or not, we need to do procedural test. See, internal controls means nothing but what? A list of process, a sequence of process which need to be followed for doing some activity. That list of procedures, I call it as what? Internal control. So if I want to know whether internal control is working properly or not, I need to verify whether all the listed procedures are followed or not. That itself I call it as procedural test. So what they are telling in the question, it has been suggested that actual operation of internal control, that is whether internal controls are operating effectively or not, that you can test by application of what? Procedural test and also examination in depth. What do you mean by procedural test? Internal control means nothing but a sequence of procedures. Whether that procedures are followed or not, I need to check it. That I call it as what? Procedural test. And in the question what they are asking is, give an example of procedure that should be followed for sales. Nothing but they are indirectly asking you how an internal control area should be there for the sales. They are asking you to give the example. So generally how internal control will be there for sales? So what they try to say here is, even in practicality also, how the entire sale process will happen is, first it should start with order getting received from customer. Customer will place an order with you. I want so and so quantity of stock. Once the order is received, what the company has to do is check whether they are having that much stock available in their godown or not. So if the stock is available in the godown, we will be able to readily supply it. If the stock is not readily available, we should give a confirmation to the customer. Sir, stock is not available. We will be ready to deliver that stock within so and so time. So whenever I give a confirmation, sir, like I will give you stock within 10 days of time. So this confirmation, whatever you have given to the customer, the same confirmation should be given to production or stores department also. Why it should be given to production or stores department? Why? Because they should keep that stock ready within that delivery date. So once that stock is ready, now I will send the stock to the customer along with the invoice. At the time of billing, I need to make sufficient agreements regarding who will bear the transport cost, who will bear the insurance cost. That I need to be clear about these terms. And also if I am making a sale, that to a credit sale, I should check what credit period should be given to him. If it is a normal credit period, well and good. If he is asking for extra credit period, I need to get approval of concerned management. This is what the procedure I need to check. So that is what even they try to say it in the answer also. Understood? So if I want to know whether the sales are happening properly or not, whether internal control in the sales are working properly or not, if I want to know this, I need to check whether this list of procedures are all compliant in an order or not. Understood? So that is what they will try to mention in the question. And there will be one more small question there which says, when you will perform compliance procedures. When you will perform test of controls, like that a small question will be there. I don't exactly remember the question number. What is the question number? Question number 12. When the auditor will perform test of controls. So many people take this question for wrong. They will think that when they are asking when I will perform compliance procedures, I will do it after risk assessment procedures. The question is not that simple there. They are not asking about timing of test of controls. They are asking when we will try to spend our time on compliance procedures, when we can all together skip the compliance procedures and directly do substantive audit procedures. Why? Because we know that risk assessment procedure will not give us the audit evidence. What we will know from risk assessment procedures? We will just identify where there is a risk, where there is no risk. Compliance procedures also will not give us the evidence. What they will do? They will only let us know whether the internal controls are working effectively or not. We are going to get our ultimate evidence only by performing what? Substantive audit procedures. So one thing is very clear, we will get all the evidence required from performing substantive audit procedures. So can I skip compliance procedures? Why? Because I am getting only evidence at substantive audit procedures. Yes, you can skip in some circumstances. In some circumstances, you can skip it. They say when you will, the question is when you will perform compliance procedures, test of controls. That means indirectly they are asking when can we skip the test of controls. If they are asking when you will perform test of controls, that also indirectly means what? When we can skip test of controls. So when we can perform internal controls, when we can skip the internal controls verification and directly proceed with the test of details. So what they say is while assessing the risk of material misstatement. That means while performing risk assessment procedures, there you have a expectation that internal controls will work effectively. That means at the time of performing risk assessment procedures only, I came to know that, okay, these internal controls will work properly. I want to rely on internal controls to decide how many substantive procedures I should do. Then I will spend time on performing test of controls. Which means if I put it in a negative sense, while doing risk assessment procedures only, I came to know that controls are completely waste of time. I did not verify. At the time of understanding only, I came to know that internal controls are completely waste here. Now once again will I spend time on verifying that controls? No. What I can do there? Skip that internal controls verification and proceed with substantive audit procedures. They say in the positive sense, I explained it in a negative way. So if you read the first point, what they try to say is, at the time of assessing the risk of material misstatement at the assertion level, you have an expectation that internal controls will work effectively. That means at the time of risk assessment procedure, if you don't have an expectation that internal controls work effectively, then what I can do? Skip the test of controls and directly jump to substantive audit procedures. Understood? And one more second point, what they try to say here is, we will perform test of controls when we believe that substantive audit procedures alone will not give you audit evidence. Which indirectly means that if you in some circumstances come to know that it will be enough for me to perform substantive audit procedures, I will get all the evidence only from substantive audit procedures. If you have that confidence, then also you can skip test of controls and directly do substantive audit procedures. These are the only two reasons there. The last point is just a repetition. What they try to say here is, a higher level of assurance you will try to obtain a higher level of assurance you will try to obtain regarding test of controls when it is impossible or impracticable to obtain all the evidence required from substantive audit procedures only. Nothing but other way of telling second point only. That means what they indirectly try to convey is, if I believe that substantive audit procedures alone will not give me audit evidence, then I will try to obtain more assurance regarding test of controls, which indirectly means that if I have a confidence that substantive audit procedures alone will give me all the required audit evidence, then I will not try to obtain assurance regarding effectiveness of internal controls. Understood? So this is what one small question which will be there. And one more thing they say, how the risk assessment will have an impact on your audit strategy. So like one more small question. See, these questions might not be tested in the direct descriptive questions, but they have a chance of getting tested in the form of true or false. Somehow they will try to twist it in the MCQs or true or false. That's why I'm spending a time. So here, this one, I will explain only two more questions and we'll stop this chapter. We'll proceed with the next chapter. So what is this question number 13 says is, when you identify weaknesses in the internal control, what impact will you have on strategy for the audit? What impact you will have on control risk assessment? See, when they say strategy here, what do they mean by strategy is whether we can rely on controls or not to rely on controls. That is the only strategy. When they say what will be your impact on the strategy of audit, what does that mean? Whether we will take a decision of relying on controls or not to rely on internal controls. In this, one important thing which they try to say here is, sometimes an area will have internal controls. That area is, for example, take some purchases area or any other area in the financial statements. In this purchase area, there is only one internal control to protect mistake from happening. There is only one particular internal control to protect the misstatement from happening. There is no alternative for this internal control. This purchase area is protected only by one internal control, and if that internal control is only not working fine, so what decision you will take regarding internal controls? Will you rely on controls or not rely on internal controls here? I will not rely on internal controls. Why? Because there is only one internal control protecting this particular area, and that internal control is not working fine. What will be my strategy? I will take a decision not to rely on internal controls. And assume that sometimes an area will be protected by so many number of internal controls. Then for deciding my strategy, I should not decide it on the basis of just evaluating one or two controls. I have to take that decision by evaluating all the related internal controls. See, if one internal control is not working fine, but to compensate for that, other internal control is there. So many controls are there. Like for example, company is having a policy that each and every transaction should be approved. So they have two controls for this. One is, first they will write a voucher which will be signed by the manager. And one more thing, this entry will go into the system only when the manager clicks approve button in the system. So two controls are there to protect the same area. For example, assume that voucher is not signed, but that entry is not getting recorded unless and until manager clicks that approve button in the system. So even though if voucher related control is not working fine, it is getting compensated by online approval. So now, since even though this control is not working fine, it is having a compensatory control. If such kind of compensatory controls are there, then what decision you will take? Rely on control or not rely on internal control? Rely. Why? Because even though if one control is not working fine, it is getting compensated by another internal control. Whereas if one of the internal control is not working fine, but there is no compensatory control for that, then what we will do? Not to rely on internal controls, we will decide. Understood? So this is the key extract from that question. I did not explain the entire question, but if you understand these conceptual things, it will be more than enough. Clear everybody? They might test it in the form of true or false or MCQs. Now we will have at the end one more last question. What will be the functions of the internal auditor with regard to internal controls? Something like that, a small question will be there. Or what are the functions of the internal auditor? Like that also they can ask. So what internal auditor will do? First one, he will evaluate internal control system, find the weaknesses in that, and even suggest the improvement how to overcome that weakness from the system of internal controls also. Not just telling whether they are working effectively or not. Even internal auditor, what he will do? He will give suggestions even for improvement of that internal controls also. Then after that, he will evaluate operating information and financial he will evaluate financial information. He will check the financial information, whether these books of accounts, financial information, all these are reliable or not. He will check the financial information. Not just financial information, he will even check operating information also, like production data, HR data, even this operating information also he will verify, and he will ensure that laws and regulations of the entity are complied with. So these four are the broad objectives or functions of the internal auditor: evaluating internal control system and also giving suggestions for improvement, reviewing the financial information, evaluating the operating information, and also the last one, compliance with the laws and regulations. Clear about it? This is what the entire concept regarding risk assessment and internal control. Understood? So I think this chapter is a bit trouble. Why? Because the difficulty in the terms, sentence formation will be there. So I would suggest you to keep it at the last. Try to read it as close to the examination as you can. Why? Because it contains a lot of complicated terminology. The problem is, even though how many number of times we read, we tend to forget this chapter. Why? Because the nature itself is like that. So the sentence formation will be a bit difficult, terminology will be very new. So what I would suggest is, try to prepare for this chapter. If you have already prepared, you will do the revision. No, even on the day before examination also, when you go for revision, try to revise this chapter as close to the examination as you can. Don't take it up in the initial time only. At the time when you are close to closing the preparation, at that point of time you read this, so that if you read it latest to the examination, you can retain a lot of content. That's only my intention there. Okay, clear about it? Right. So having said that, let us now begin the next chapter. Any problems or confusions or doubts still here? Nothing? Shall we proceed then? Right, very good. In the meantime, if someone asks from the online mode, then I will address it. So, but anyhow, successfully, let us start the next topic also. So now we are going to cover fraud and responsibilities of auditor. Okay. Fine. So let us talk about now fraud and its related matters. So first of all, definition of fraud, and which standard we are going to cover as a part of this chapter. SA 240 is the related standard which we are about to cover from this chapter. So first of all, we will start with definition of fraud. So what is the definition of fraud? It is an intentional act, and it could be committed by one or more individuals. That individuals can be among management or those charged with governance or employees or even third parties. So an intentional act, that means knowingly someone is doing it. It can be done by one or more individuals. That individuals can be among management. That individuals can be among those charged with governance. That individuals can be among employees, or even they could be among third parties. And it always involves the use of deception. Deception means cheating. It always involves cheating the organization. For what purpose? To obtain an unjust or illegal advantage. That means to get some advantage which is illegal, or to get some advantage to which you are not entitled to. That is what the meaning of unjust. So an intentional act when done by one or more individuals among management, those charged with governance, employees or third parties, involving the use of deception to obtain an unjust or illegal advantage, that we call it as what? Fraud. And we know that this misstatement is this fraud is one of the kind of misstatement. And the misstatement can arise from two things. One is what? Fraud, and other one is going to be error. Now, even if we talk about fraud also, see, anything done intentionally, we call it as fraud. But as an auditor, should we be concerned about each and every fraud happening in the company? Obviously, no. We should be concerned about only those frauds which causes a material misstatements in the financial statements. It is not that each and every fraud we have to be concerned about it. Only those frauds which create a what? Material misstatement, we have to be concerned about it. And also, on the basis of the things getting committed, frauds will be broadly categorized into two ways. What are they? Fraudulent financial reporting and misappropriation of assets. So there is another name for fraudulent financial reporting. We even call it as manipulation of accounts also. So what will happen in the fraudulent financial reporting? In the fraudulent financial reporting, what management will try to do is they will try to project a wrong picture through the financial statements. What they will try to do? They will try to project a wrong picture through the financial statements, either by way of inflating or deflating, by showing higher profits or lesser profits, by showing higher assets or lower liabilities, whatever it is. If the management is trying to show a wrong picture through the financial statements, that we call it as what? Fraudulent financial reporting. The name itself says financial reporting, the process of preparation and presentation of financial statements. Fraudulent financial reporting, the management is trying to present the financial statements in a fraudulent manner. They are trying to give you a wrong picture through the financial statements. So that's why we call it as fraudulent financial reporting, and even it can be alternatively called as manipulation of accounts also. Then comes a misappropriation of assets. What will happen in the misappropriation of assets? It involves theft of entities' assets, or damage to the entities' assets, or unauthorized usage of entities' assets. So that means it involves some damage happening to the assets of the company. Like it could involve theft of stealing of the entity's assets, stealing or theft of entity's physical assets or intellectual property. It doesn't only happen for a physical asset. Even if some secret code of the company or some software code of the company, even if that is also stolen and communicated to the competitor, that will also come under misappropriation of asset. And it also involves causing an entity to pay for the goods and services which are not received. That means company did not buy any goods. Employees are creating fake vouchers. Employees are creating fake bills. And through that fake vouchers and fake bills, they are causing an entity to pay for that money. Fake invoices they are generating. Or it even involves misuse of entities' assets also. See, company has bought some asset for official purposes, but the so-called concerned employee, instead of using it for official purposes, is using it for personal purposes. This also will come under misappropriation of assets. Like company has got one vehicle, some four-wheeler for the purpose of official purposes, but that particular driver of the company, he has registered that cab on Ola and started providing services of that Ola services. So this is also a what? Misappropriation, misuse of the entity's assets. So this is what we call it as a misappropriation of assets. So which involves damage to the entity's assets, either by of theft or misuse or other things. Now, sir, why management will commit fraudulent financial reporting, sir? See, whenever I say fraudulent financial reporting, detecting the fraudulent financial reporting is very difficult. Why detecting fraudulent financial reporting is very difficult? Why? Because top level management always be involved in it. Without top level management's involvement, this can't happen. Why? Because management are the people who are preparing the financial statements, who are presenting the financial statements. So without management's involvement, I don't think this fraudulent financial reporting will happen. So generally, why fraudulent financial reporting will be created, sir? With what objective they will try to create? They say broadly 4 reasons there. One is to avoid incidents of taxation. So companies make lot of profits, but they don't want to pay the taxes on that profits. So that could be the initiative, that could be the incentive for the management to create this fraudulent financial reporting to avoid the tax. That means they try to underreport their incomes to pay the lesser taxes. That could be one reason. And one more reason, to declare the dividend when there are no enough profits. So there are no enough profits. From the last few years, company is making dividend, payment of dividend. In the current year, they made a loss. If they stop making payment of the dividend, the shareholders will get a wrong notion about this company. So to protect their brand image, even though there are no profits, they will try to inflate the profits and still pay the dividend. That could be one reason. Sometimes they want to withhold the dividend even when there are enough of profits. The company has made enough of profits, but board of directors don't want to share the proceeds of the profits with the shareholders. They want to eat away some profits. So what they will do is they will underreport the profits. And one more thing they will try to say that when the managerial remuneration is linked with profits of the company. Today it is very quite common for CEO or CFO salary to be linked with the profits, 5% of the profits, 2% of the profits. So what this top level management will do is, if they want to get higher remuneration, company has to make higher profits. But what they will do is, even though the company did not make higher profits, they will try to show higher profits so that they will get higher remuneration from the company. So these are the 4 reasons why management will commit a fraudulent financial reporting. Tax motivated reasons, withholding declaring dividend, or declaring the dividend when there are no enough of profits, or management's remuneration is linked with profits of the company. So these are the reasons why they will create. Now, how this fraudulent financial reporting will be committed? So when it comes to this question how, it can happen in various ways. One is by inflating or suppressing. So what and all you can inflate or suppress? So if you want to increase the profits, we can increase revenue, suppress the receipts, suppress the payments, that is purchases. If you want to decrease the profits, you can suppress the revenues, inflate the expenses. So simply by inflating or suppressing, the company can try to project a wrong picture, or even they can try to change that value of the inventories also. That could also lead to that could also create a wrong picture. And also sometimes they will intentionally misapply the accounting policies. Like for example, capital expenditure will be shown as revenue, revenue will be shown as capital. So because of this wrong application of accounting policies, also wrong classification also, they can try to show their wrong picture through the financial statements. So like that, various techniques are available. How come the management can commit this fraudulent financial reporting? But whatever it is, when we do a comparative study between misappropriation of assets and fraudulent financial reporting is highly difficult to be detected. Understood? Now, if you come to misappropriation of assets, the most important asset, the most vulnerable asset to misappropriation is what? Cash. So cash is the most vulnerable asset or most easiest asset which can be misappropriated. So when it comes to cash, misappropriation of cash can also be called by other name. We even call it defalcation of cash. And this defalcation of cash can happen broadly in 2 ways. One is by inflating payments. Inflating what? Payments. Other one is suppressing the receipts. So when it comes to inflating the payments, this you can do it in multiple ways. One is fictitious vouchers. Create the fictitious vouchers. Sometimes vouchers will be genuine, but amount thereon will be inflated. So amount can be inflated in the vouchers. That also you can do. Few more things they will say. I don't exactly remember those points. Manipulating the wage rolls of the company. That means whenever you are making the salary payments, you will try to add wrong totally. And posting wrong totals from petty cash book to main cash book. So these are the various ways in which payments can be inflated. Now when it comes to suppressing of the receipts, the most important thing is what? Teaming and lading fraud. So in this, what will happen in this technique? So assume there are some 3 customers A, B and C. Mr. Customer A has paid the money to the cashier, but cashier misappropriated it. Now if he misappropriated it, he will not record it in the A's account. Now if you don't record it in the A's account will be shown as overdue. And if A's account shows overdue for a long period of time, it will get whose attention? Management's attention. If it gets the management's attention, what they will do? they will communicate with the debtor. Then they will come to know about the real thing. What is the real thing here? The customer has actually paid the money, but cashier misappropriated. So in order to avoid this account going to the management's attention, what the cashier will do is, subsequently when he received the payment from Mr. B, that he will not record it in the B's account, he will record it in A's account. Now after certain period of time, B's account will be shown as overdue. To overcome this, what he will do once again? Amount received from the C will be recorded in the B's account. Now this process will go on for some period of time, and at one certain point of time, even cashier also will be confused how much amount has to be exactly received from each of the customer. So this technique we call it as what? Teaming and leading. So there will be other techniques also, like giving unauthorized rebates or discounts, or you have received the money from the debtor, but you have completely written off that debt as bad, and not accounting for cash sales fully. So like that, various techniques also will be available. And by simply casting wrong totals in the cash book also, we can do this defalcation of cash. And one more main reason why this misappropriation of assets will happen is, why? Because internal controls will not be operating effectively. What is the main reason for this misappropriation of assets to happen? The assets which are the internal controls which are supposed to protect the assets, they might not function properly. That could be the main reason why this misappropriation of assets will happen. Like some internal control lapses, like lack of inappropriate segregation of duties. Like see, actually there will be one question for this. Let me take you through that. What is the question number here? Question number 12. Yeah, this one. So that means if you have inadequate internal controls, then there are high chances for misappropriation of assets. So what are the examples of that inadequate internal controls? Like having no segregation of duties. That is, a person whoever is handling the asset, the same person is even maintaining records of that asset. And similarly, inadequate oversight of senior management expenditure. That is, what expenditure top level management is making, no one is paying attention to that. Similarly, no proper record keeping. Whenever like inventory records are properly not maintained, even when inventory is consumed, it is not getting updated in the books of accounts, or there is no system for approval, there is no mechanism for approval. Just like that, any person can go and incur the expenditure on behalf of the company. No physical safeguards, like no CCTV cameras and no security guards were appointed, and you are not doing the reconciliation of the books of accounts on a timely manner, and also no documentation you are maintaining, or lack of your employees are not going on mandatory vacations, and also top level management is not making initiative to understand the information technology. So when you have these kind of inadequate internal controls in the company, there are more chances for the assets to get misappropriated. Clear, everybody? Right. And now, since we have understood these many matters, but we did not understand one significant thing: responsibility. Who is responsible for detecting of a fraud? So SA 240 says one thing: the primary responsibility, the basic responsibility for preventing the frauds from happening, and also if they have happened, detecting and taking appropriate action. The primary responsibility is whose? It is the management's primary responsibility to prevent the fraud from happening, and even if the fraud has happened, to take appropriate action on it, and also to detect it. These are the responsibilities of management. Then what about auditors' responsibilities? In order to understand auditors' responsibilities, we need to have some discussion. Like, see, what is the main objective of the auditor? To express an opinion on the financial statements. And we know that as a part of that, main auditor is neither appointed exclusively to identify the frauds only. We are not appointing him with this exclusive objective. So the main objective of the auditor is to express an opinion. And also he need to maintain professional skepticism throughout the audit. And they say some statements: the risk of not detecting a fraud is higher than risk of not detecting an error. And also in the fraud also, the risk of not detecting a management fraud is higher than risk of not detecting an employee fraud. And whether auditor will be able to detect a fraud or not, that depends on some factors. What are those factors? It depends on skillfulness of the perpetrator. That means the person whoever is committing the fraud, how skillful he is. If he is very skillful, it will be very difficult to detect. If he is a waste fellow, it will be very easy to detect. Yes or no? So it depends on the skillfulness of the perpetrator. It also depends on relative size of the amounts. This is something called relative size. If the fraud is happening in small amount, it will be difficult to detect. If once a bulk amount happens, then it will be very easy to detect. It also depends on frequency with which the fraud is committed. If it is conducted with a lot of frequency, there are more chances for coming into my sample. If it is conducted once in a while, there are more chances that it might not get covered in my sample only. So that is also one reason. It also depends on experience of that particular individual. If he is having experience, he will have control over so many areas, he will be able to manipulate it well. And also it depends on degree of collusion involved. If a single person single-handedly done the audit, somewhere he will get caught. If so many people in the organization are colluding, joining their hands, conducting the audit in a combined manner, then it will be highly difficult for the auditor to detect the same. And one more thing they say, if auditor was not able to detect a fraud, whether he will be held responsible or not, it depends on how effectively auditor was able to do the audit. That means whether he did the audit negligently or not. If the auditor has done the audit negligently, then only there will be a responsibility on the auditor for not identifying a fraud. On the other hand, if the auditor has put all his sincere effort, he was not negligent, even after putting all his efforts also, still if he is not able to identify the fraud, then he will not be punished. Now, who has to prove whether auditor did the work sincerely or not? Auditor himself has to prove. Using what he is supposed to prove this? Using the audit documentation, he has to prove before the regulatory authorities that he did the work sincerely, and even after putting all that effort also, still he is not able to identify fraud. Understood? So along with that, they say one more thing. Whether you take fraudulent financial reporting or even if you take misappropriation of assets, for any fraud to happen, there will be three things required. One is it all starts with pressure or incentive, and that pressure alone will not be enough. That pressure should be supported by an opportunity. A perceived opportunity should be there. Pressure and opportunity alone will not be enough. It requires rationalization or attitude of the individual. Like for example, if you take fraudulent financial reporting, it will happen. Why management will try to project wrong picture to the financial statements? When they are facing some pressure, like for example, they have given a target, but they are not able to achieve the target. If they don't meet the target, then what will happen? It will have an impact on the share price. Now a pressure gets created. Or management wants a loan. If they don't show higher assets, banker is not ready to give the loan. Pressure on the management. If you take misappropriation, why employee will create a fraud? Why? Because he might be going through immense financial pressure. So the starting point for any fraud to happen is what? Pressure. And then that pressure alone will not be sufficient. Opportunity should be there. For example, an employee is going through immense financial pressure, but internal controls in the organization are so strong that even there is not even a single opportunity to commit a fraud. Will he be able to commit the fraud? No. So pressure alone will not be enough. It should be supported by some opportunity. Opportunity like some weakness in the system of internal control. And pressure and opportunity alone will not be enough. You even need what? Rational attitude. See, some people will be brought up in a good attitude, good environment. They will not be able to justify their wrongdoings. That means even if they commit something wrong, they will not be able to justify. So those kind of people will not commit a fraud. On the other hand, some other people will be there. Even if they commit a fraud, they will assume it as their birthright. That means they will have that. They have all the valid reason to justify their wrong actions. Then they will be easily committing the fraud. So it requires even rational, that is logic or attitude of the individual also. So for any fraud to happen, either fraudulent financial reporting or misappropriation, these three things are must: pressure to commit a fraud, opportunity for committing a fraud, and it should be supported by rational, that is attitude of the individual also for committing a fraud. Now they say one more small concept from this chapter, which is fraud risk factors. So fraud risk factors are nothing. See, in other standards also we have seen, like SA 250, they has given some factors which indicate the possibility of non-compliance. SA 570, they have also given some factors that create a doubt regarding entity's ability to continue as a going concern. Similarly, SA 240 is also giving some factors which give a doubt that here there could be a possibility of the fraud. That factors has been given specific name in the SA 240 as fraud risk factors. So fraud risk factors are nothing but those factors which indicate that there could be a pressure for committing a fraud, which even indicate there could be a opportunity for committing a fraud, and even they can also indicate attitude for committing a fraud. And what SA 240 done is they have identified fraud risk factors for fraudulent financial reporting separately, misappropriation of assets separately. And under each of these categories of the fraud also, they have identified fraud risk factors separately for all these three things. The factors which indicate pressure, the factors which indicate opportunity, the factors which indicate rationalization. Even for misappropriation of assets also, they have identified fraud risk factors which indicate pressure, which indicate opportunity, which indicate rationalization or attitude of the individuals. So totally under 6 categories, they have given the fraud risk factors. And we have 2 dedicated questions which will explain what are those fraud risk factors for misappropriation of assets, what are the fraud risk factors for fraudulent financial reporting, divided under 3 categories. And I think we need not go through it. Why? Because point wise only, no, so it is not that suitable for revision, so I am skipping it. I told you concept of fraud risk factors, that list of examples which we can go through. Even if I revise also, it will be just like opening the material and reading the points. Not worth it, no, right? So let us try to spend time on some other things, some more things. So one thing they say about self-revealing errors. A question will be there regarding self-revealing errors. What do you mean by self-revealing errors? Those errors which reveal by themselves without making any extra effort by the auditor. That means in the process of preparation of financial statements itself, the errors is getting automatically identified without any auditor's extra procedures. Those kind of errors we call them as what? Self-revealing errors. Like example, you can take only posting one side of the entry to the ledger. Trial balance will not match. You will be able to automatically identify it. Or amount received from one customer recorded in another customer. So when you ask a payment for him, automatically that customer will say, I have already made the payment, no sir. So he'll be able to automatically identify it. So like that, some examples they will try to give there. Able to understand? Or wrong totaling of the purchase register, which will also have an impact on the trial balance. But in short, self-revealing errors are those errors which reveal themselves without any additional effort to be taken by the auditor. And one more thing they say, sometimes because of fraud, auditor might not be able to continue the audit assignment. Inability of the auditor to continue audit because of a fraud, then what he is supposed to do? They say simply one thing. First, when you come across any fraud which is putting a difficulty for you to continue as an auditor, first try to communicate this matter with concerned officials in the company or regulatory authorities. Then determine whether withdrawal from the audit is necessary. If you decide withdrawal from the audit is necessary, yes, happily you can resign from the audit. But after or before resignation, determine whether there is any obligation on you to communicate with those people who have appointed you or the regulatory authorities about your resignation. Like in the case of company, we can't just like that resign. No, we need to file that form 883 and all. So like that, determine whether there are any obligations on you to communicate about your resignation with either with those people who have appointed you or with the regulatory authorities. Simply summary, what they try to say is, if you want to resign, resign it. Nobody will stop you. But determine whether there is any obligation on you to communicate with either the people who have appointed you or communicate with the regulatory authorities. So like that, one question will be there. And one more question. Scope of inquiry under CARO. Some question will be there. Scope of inquiry for fulfilling the CARO reporting requirements. Question number 15. Okay. Yeah, this one. See now this is also given in test your knowledge. That's why I'm putting emphasis on this. High chances of getting tested in the examination. So what they try to say here is, see under CARO, point number 11, like yesterday we have revised in CARO 2020, point number 11, auditor is required to make a report regarding fraud. 3 things he is required to communicate. What is that? Whether any fraud is noticed or reported. If yes, nature and amount involved. Whether any of the auditors submitted form 84. Next one, whether have you received any whistleblower complaints. We know that reporting requirements. But this question is asking how you will fulfill these reporting requirements. How you will fulfill. See, if I have to report these matters, first I need to get that information. No. How you will get that information? By conducting inquiry. With whom you will inquire? That is what they are talking about here. Understood? They are not asking reporting requirements regarding fraud under CARO. What is the question here? How you will fulfill that reporting requirements? How you will get that information regarding these matters and fulfill that reporting requirement? and simply they say we have to conduct inquiry. With whom you will conduct inquiry? Like for example, if I want to know what is the, if any fraud is identified and noticed, and if I want to know what is the nature and amount involved, I need to conduct inquiry. With whom you will inquire? Sir, I will go and inquire with management to know whether any fraud they have found out. If there is an internal auditor, I will go and inquire with internal auditor, or I will at least read the internal auditor's report. And even I will discuss the matter with other employees. Even with low level employees also, I can go and inquire. From that also you can get to know about information of fraud. Second, I want to know whether any of the auditor filed form 884. How you will come to know whether form 884 has been filed or not? If you verify all the filings which are made with the ROC. In the today's environment, how you will come to know what filings are made with the ROC? Ask your client to log into their MCA portal, go to their MCA portal and check what and all forms have been submitted. If any auditor submitted form 884, that will be clearly reflected in their MCA portal. So check with the management what and all filings they have done with the ROC in the current year. Next one, whistleblower complaints. How you will come to know whether there are any whistleblower complaints or not? Simply they say one thing, inquire with the management. Go and ask the management, have they received any whistleblower complaints? That's all. So this question is about how you will fulfill that CARO related reporting requirements regarding fraud and regarding the fraud reporting of the auditor. Understood everybody? So this is what will be there in this fraud and responsibilities of the auditor. I think all the questions, all the major concepts from this particular thing is covered. Clear? So we are well met our targets. So now we have coming 2 hours. So I will spend some time on audit sampling. Then I will also spend some time on analytical procedures. After that, I will take up audit of banks. Since so many people will keep on asking this, so I will take up audit of banks. If after that also the time is left out, I think the time should be enough for this. But if after that also, if the time is left out, I will try to quickly cover audit in an automated environment. Just I will try to give you a overview of audit in an automated environment. If after that also time is there, if time is there, audit strategy, planning and program, not the complete chapter, just I will talk about that materiality related matters. Why? Because very important materiality from the examination perspective. So that materiality related discussion I will explain, and I do personally feel that after this we will not have time. Okay, so even by chance if we have time after that also, so why to talk about uncertain things which will not happen? So leave it here only. So depending upon the availability of the time, this is what I will be covering in the coming 2 hours. Okay, right. So still time is left here. You have to come for afternoon also. Fine. So that is what we'll be doing in the next 2 hours. So that's all for now. Let us leave for lunch. We'll meet again exactly at sharp 3 o'clock. Okay. Fine. Bye. See you at 3. I will wait here for 10 minutes if you want. If you have any concerns, you can approach me. Those who want to leave, you can leave. I will be there here for 10 minutes. If you have any concerns, you can ask me. Okay? It's up to you. You can leave. Those who want to leave, you can leave. No problem. Good afternoon. Please take your seat. Okay, so shall we start? Fine. So we will start now with the topic called audit sampling, and the related standard which we'll be covering here is SA 530. That will be the SA 530 will be the standard which will be talking about this audit sampling and its related matters. First of all, let us try to understand a few definitions. Like first one, we need to understand about the term population. So the meaning of the term population is the large mass of data that we generally call it as population. Like for example, the large mass of students who are sitting here, so you are one population. Similarly, a large group of transactions, for example, assume in the purchase area there are total some 10,000 transactions. That 10,000 transaction is a population of the transaction. So population means the large mass of data that we call it as generally population. And there will be a term called sampling unit. Sampling unit means nothing but the constituents of the population, we call them as sampling unit. Like your class contains a total population of 220 or 250 people, somewhere around it. So each and every one of you will be called as sampling unit. Why? Because you are constituting for creating this population. And next term that we need to understand is sample. That means out of your entire population, if I select a few sampling units to know or to get an understanding about this entire class. So that sampling units which are selected from the population for performing some procedures, that group of items we call them as what? Sample. So like out of your entire class of 220 people, I want to know how far you are comfortably understanding this auditing marathon classes. So I can't keep on questioning each and every one of you. So what I thought is, let me take from you from randomly some 10-20 people I will pick. So that people will be sample. I will be posing the questions to them. If they give me appropriate answers, I will form a conclusion whether this class is having understanding or whether this class is getting benefited from this marathon classes or not. So that is what the sample means. Now, when it comes to the auditing perspective, as I told, there is a standard SA 530. That standard is defining the term audit sampling in a technical manner. So how this particular standard is defining the term audit sampling? They say that audit sampling means performing audit procedures to less than 100% of items in the population. What is the meaning of audit sampling? Performing audit procedures to less than 100% of the items in the population. For example, if there are some total of 10,000 transactions, I am not performing audit procedures on the total of 10,000 transactions. For less than 100% of the transactions, I am performing audit procedures. When I say less than 100%, it could be 10%, 5%, 20%, 30%, it could be even 99% also. But I am not performing audit procedures on entire transaction. For example, out of this 10,000 transaction, I have taken some 10% of the transaction, which is 1,000 transaction. Now I am performing audit procedures on this less than 10% of the transaction. Now after performing this audit procedures on the sample which I have selected, I need to form a conclusion. My doubt is, will I form a conclusion on just the sample which I have selected, or will I form a conclusion on the entire population from which the sample is selected? I am going to form a conclusion on entire population from which the sample is selected. My conclusion will not just be restricted to sample. So performing audit procedures to less than 100% of the items in the population in order to form a conclusion on entire population from which the sample is selected. That process we call it as what? Audit sampling. And SA 530 is going to help us to determine, to help us how to perform this sampling and how we can effectively perform the audit procedures on the sample, and we can form an effective conclusion on the entire population. Enough of guidance has been provided under SA 530. And SA 530 says one more thing: if your sample results has to be correct, if your conclusions, whatever you are drawing on the population are required to be correct, your population should be having some characteristics. Who should be having characteristics? Population should be having some characteristics. So what characteristics there should be there for the population? That is, first one is appropriateness. My population should be appropriate. So relevant people only should be there in my population, or relevant transactions should be there only in my population. And my population should be complete. completeness should be there. My population should not be from my population from which I am selecting the sample, that should not be a incomplete population, that should have complete transactions. And also that population should be reliable. So if the population is reliable, then only the sample conclusions can be reliable. If the population from which you are selecting the sample itself is not reliable, how can you consider, how can you assume that the results of the sample are going to be reliable? So in order for the sample results to be correct, the population should contain these three characteristics. What are they? Appropriateness, completeness, and reliability should be there. So then only sample results could be correct. Now, and one more thing, the standard says that whenever we have to go for sampling, there are two broadly available methods for selecting the sample, two broad approaches to the sampling. So what are the two broad approaches? One is statistical sampling and other one is non-statistical sampling. So what do you mean by this statistical sampling? See, this refers to such a sampling where there will be a random selection of items. What do you mean by random selection? Each and every item will have equal chance of getting selected in my sample. And also this method uses scientific approaches. This method is using what? This method is very scientific and it is going to be very objective also. Objective means unbiased. Since I am giving equal importance to each and every item, this method will be even what? It will be even objective. And here we are going to make use of mathematical theories and also probability theories for the purpose of selection of the sample. So the method which has a random selection, which is very scientific and objective, and which uses mathematical and probability theories, and also which takes into account sampling risk characteristics, that approach we call it as what? Statistical sampling. Then what do you mean by non-statistical sampling? Simply that approach of sampling which doesn't have these characteristics, that we call it as what? Non-statistical sampling. That means simply in the non-statistical sampling, how the sample will be selected means purely using professional judgment of the auditor. How the sample will be selected? Purely on professional judgment. Which approach? Non-statistical sampling will be selected purely on the basis of professional judgment. Like auditor is feeling March month transactions might contain more misstatement, he has selected entire March month as a sample. So how he has selected the sample here? Using his professional judgment. And this non-statistical approach is neither scientific nor objective. We are not going to use any statistical concepts here. At the same time, it will not be objective also. Why? Because whenever I say professional judgment, it always includes bias. The risk of bias cannot be eliminated in the case of non-statistical sampling. But they say some concluding points. See, you can follow either statistical or non-statistical, but comparatively, which one will be much better? Statistical sampling will be much better. Does that mean you should always use statistical sampling only and you should not make use of non-statistical sampling at all? It is not like that. It is purely auditor's judgment. The standard has to let the auditor decide which approach he wants to use, whether he wants to go with statistical sampling, whether he wants to go with non-statistical sampling. Let the auditor decide. The standard is not giving any hard and fast rule, but standard gives some general instructions like, if you want to whatever may be the approach of sampling, your sample should be representative of entire population. What do you mean by representative of entire population? Whatever characteristics are there in my population, all those characteristics must be covered even in my sample also. My sample should be representing entire population, not just it is having only one of the characteristics. Understood? Right. And also we have some general questions like what will be the advantages of statistical sampling? They say when it comes to advantages, the sample size does not increase in proportion to size of the population. And also here we are going to have a limited risk. With the calculated risk we can take here. And also with a limited sample size, we can try to reduce your risk at a low level. Since this method is very scientific, it is globally accepted and it provides a better description of large mass of data than the prima facie examination of all the transactions in the population. So these are advantages. Then we have one specific question called, what are the factors which affect the auditor in deciding on checking on the extent of sampling plan? Something like that equation will be there. What are the factors that affect the extent of sampling plan? So the meaning of this question is, see, we have seen sampling SA 530. Audit sampling means performing audit procedures to less than 100% of the items in the population. Is it mandatory on the auditor to use the sampling? Is it mandatory for the auditor to compulsorily verify the transactions on sampling basis? The answer is no. The standard is not telling verification of transactions on sampling basis is mandatory. Not just verification of transaction, any standard will not say what exactly needs to be done. So starting from our 0 chapter, they will always give us various opportunities, and finally they will say one thing: decide on your professional judgment. So similarly, when it comes to verification of transactions also, whether 100% verification has to be done, whether sampling has to be done, regarding this also they did not give any hard and fast rule. They have simply left it to whose judgment? Auditor's professional judgment. Let the auditor use his knowledge, experience and training and decide whether he wants to verify 100% of the transaction or sampling. The standards are only expecting from him to express the opinion. It is immaterial whether he is doing it by doing 100% verification or sampling. The standards are not putting any rule. Now, the auditor, while taking the decision whether I have to verify 100% of the transactions or whether I have to verify the sample, he will consider various factors. What are the factors which he will consider? The factors which he will consider, like first one, size of the organization he will consider. If your size of the client is very, very small, you can do 100% of verification there. If the size of the client is very big, like Reliance Industries Limited, they're doing 100% of the verification is close to impossible. So it depends on size of the organization. It depends on risk of material misstatement. Like if the risk is very, very higher, I might not comfortable in using this sampling. I will try to do 100% verification there. It also depends on effectiveness of internal controls. If the internal controls are very effective, I might be feel very comfortable to go for sampling. If the internal controls are not at all operating effectively, there I might feel that 100% verification could be suitable. So it depends on level of effectiveness of internal control. It even depends on reliability of books and documents. If the books are more reliable, I will be comfortable in using sampling. If the books are not that reliable, I better try to go for 100% of the verification. And one more thing they say, it depends on tolerable error range also. It also depends on the risk which I am willing to tolerate, the error which I am willing to accept. If I am willing to tolerate some risk, then I will go for sampling. If I am not willing to tolerate the risk at all, then I might decide to go for 100% verification. So these factors auditor shall keep in mind while taking the decision whether 100% verification will be suitable or sampling is going to be suitable. That depends on these factors. Auditor will analyze these many number of factors, then he will come to a conclusion. Clear everybody? Now. So now let us shift our discussion on understanding something related to techniques for performing the statistical sampling or various methods for performing the sampling. So we have various number of methods available here. The most widely used method is random sampling. And even in this random sampling also, there will be two more techniques available. One is simple random sampling, other one is stratified random sampling. So when it comes to simple random sampling, what is here will happen is, here every item will be given an equal chance of selection. Sir, how can it be given every item equal chance of selection, sir? By using some tools like random number tables, random number generators, or even in the class I have shown you, even Excel also we can make use of it for generating the random numbers. So we are going to select the items from the population using this tools like random number tables, random number generators. Whereas in the case of stratified sampling, here what I will do is, see, and one more thing, simple random sampling will be suitable when the transactions are homogeneous, when the transactions are similar and they are within a reasonable range. Whereas when the transactions are having dissimilar characteristics and there is a wide gap between minimum and maximum value, then doing a simple random sampling might not be suitable. Like for example, if I am having purchases made from 4 different vendors, when I take a sample, I want to ensure that each and every vendor's invoices should be covered in my sample. If I follow simple random sampling, I might not be able to get it. So that's why I will go for stratified random sampling. In stratified, what I will do is, First, I will divide entire population into subpopulations which contain similar characteristics. For example, if I have total 10,000 transactions of purchases made from four different suppliers. So first what I will do is I will divide this entire 10,000 transactions supplier wise, subpopulations I will do. For example, supplier A 2500 transactions, supplier B 3500 transactions, supplier C 2000 transactions, supplier D 2000 transactions. So first step is dividing the entire population into subpopulation. This process I call it as stratification. And once I do this stratification, now once again what I will do is from each of this subpopulation I will select a sample. And once again how I select the sample from each of the subpopulation? Once again using simple random, using random number tables or random number generators. So stratified random sampling is nothing but first dividing the entire population into subpopulation. From each of the subpopulation we are going to select the samples once again using random number tables and generators. This entire concept, this entire process I call it as what? Stratified random sampling. Understood? The next thing comes interval sampling, or we say systematic sampling also. What happens in that interval sampling? So in this interval sampling, what we will do first is, we will determine a value called sampling interval. We will determine a value called what? Sampling interval. Sir, how we will determine the sampling interval, sir? Even they say the formula also. Divide the total number of items in the population with required sample size you want. For example, if total 10,000 are the transactions and I want from them 500 sample size. So if I divide this 10,000 by 500, I will get a sampling interval. So what is the value here? 20. So 20 will be 20 only, no? So 20 is my sampling interval. Some n. Here I got n. So depending on the sample, here, depending upon the sample size, depending upon the population, you will get some figure, some n you will get. Now what I will do is every nth item in the population I will take into my sample. Like I will start with 1, I will take 20, I will take 40, 60, 80, like this. Every nth item I will take into the sample. So this method I call it as what? Interval sampling or systematic sampling. Then comes the next one, which is monetary unit sampling, or they even call it value weighted selection. If I am giving importance to the value of the transaction for selecting the items, for evaluation of the results, then that method of sampling I call it as what? Value weighted selection. Nothing but if I am feeling whatever transactions which are there for value, whatever invoices which are there for more than 10 lakh rupees of value, I will verify all. Whatever invoices which are there from 5 lakhs to 10 lakhs, I will verify 30% of them. Whatever invoices which are less than 5 lakh rupees, I will verify 5% of them. So that means while selecting the sample or while analyzing the results of the sample, if I am giving importance to value of the transaction and selecting the sample, that method I call it as what? Value weighted selection or monetary unit sampling. Then comes the next one, block sampling. What will happen in the block sampling means instead of picking one item, if I take a series of continuous items into my sample, that I call it as block sampling. Like for example, someone gave me a file. I have to choose that file totally contains 1000 transactions. Out of that, I have to choose 100. In general circumstances, what we will do is we will pick one item till the time I get 100. But in the block sampling, what I will do? Somewhere in between some continuous items of some 100 continuous items, I will hold them once, I will pick it at them at once. So that's picking series of continuous items, we call it as what? Block sampling. But this block sampling is not that widely used. Why? Why? Because most of the populations will be arranged in some order. Some people arrange the population in chronological order, some people arrange it in alphabetical order, some people arrange it in numerical value basis. So generally populations follow some pattern for storing. And when you take series of continuous items, they tend to have similar characteristics. So that means your sample might not be representative of entire population. So because of that reason, block sampling is not that widely used. And the last one which is available is haphazard sampling. So when it comes to haphazard sampling, the name itself says here we are not going to follow any structured technique. Even though we don't follow any structured technique, we will not let our bias also to come and play the role here. We will not also allow any bias to play a role here. So that method we call it as what? Haphazard sampling. See, it is very vague to define. Like for example, a file has been given to me. I have to pick some 10 invoices from that. I'm just closing my eyes, placing my hand somewhere. Whatever invoice gets touched to my hand, I will take it into my sample. This is what simply a haphazard sampling. I did not follow any structure technique. At the same time, did I allow my bias to come and play any role here? No. So this method I call it as what? Haphazard sampling. You see, even this method is also not superior when compared with other methods. Why this method will not be superior? Why? Because it will be difficult to establish in the future. Tomorrow if someone is asking you, boss, what is the basis for your selection of sampling? I can't say I closed my eyes and picked up randomly some items. So it will be very difficult to establish. So that's why even haphazard sampling also will not be that widely used. So these are the various methods or techniques for performing statistical sampling here. Understood? Now, in between there will be one question. What are the requirements as to sample design, sample size and sample selection? Sample design means nothing but out of these many techniques available, which techniques will be suited. So that decision I will take after giving importance to characteristics of the population and purpose of the audit procedures. Like as I have told, if the populations are homogeneous, which method will be suitable? Simple random sampling. If they are heterogeneous, stratified random sampling. So the sample design will be decided keeping in mind characteristics of the population and nature, purpose of the audit procedures. Whereas what should be your suitable sample size? When it comes to what should be our suitable sample size, they did not say any hard and fast rule. They have simply told that the sample size should be decided in such a manner that your overall sampling risk is at a low level. I should keep my sampling risk in such a manner that my overall risk is at a what? Low level. Here also simply they are leaving it out to professional judgment without giving any specific guidance. Similarly, how the sample items should be selected. We know it already. If it is a statistical sampling, we will give equal chance of selection for every item. If it is a non-statistical sampling, we will use our professional judgment. That is what will be the basis for selection of items in the sample. Understood? So these are what the requirements regarding sample design, sample size and sample selection. And there will also be one more question. What are the factors that affects the determination of sample size? What are the factors that affects the determination of sample size? That is whether you have to go with a bigger sample size, whether you have to go with a smaller sample size, that depends on what factors. So if we pay attention to this here, first, as usual, it depends on size of the organization. What kind of relationship size of the organization will have with the sample size? Direct relationship. If the size of the population is higher, if number of transactions are higher, the even sample size also will be higher. On the other hand, if the size of the organization is small, sample size also will be smaller. And it even depends on risk of material misstatement also. What kind of relationship? Direct relationship. If I identify higher risk of material misstatement, I will go with bigger sample size. If I identify lower risk of material misstatement, I will go with smaller sample size. Here also we have direct relationship. And one more thing they say, tolerable misstatement. What kind of relationship it will have? Inverse relationship it will have. How come inverse relationship? If the auditor is willing to accept more risk, tolerate means willing to accept the risk. If the auditor is willing to accept more risk, he will go with smaller sample size. If the auditor is willing to accept very less risk, his sample size will be bigger. So like this inverse relationship will be there. And one more thing they say, it even depends on expected misstatement also. Expected misstatement is nothing but risk of material misstatement only. What relationship expected misstatement will have with the size of the sample? Direct relationship. If you are expecting more misstatement, I will go for bigger sample size. If I am expecting lesser misstatement, I will go for smaller sample size. And one more thing they say, it even depends on degree of assurance which auditor requires, the level of confidence required by the auditor. If the auditor requires more level of assurance, he will go for bigger sample size. On the other hand, even if he is satisfied with low level of assurance, he will go with lower sample size. And once again, what kind of relationship? Direct relationship. Very important to understand this relationship between the items and the sample size. They might pose a question in the form of MCQs and true or false statements regarding this relationship. Understood? Clear everybody? So this is regarding factors which affects the sample size. Now let us talk about next most important topic, which will be sample risk, sampling risk. So what is this sampling risk? Nothing but in layman terms, if I have to say, sampling risk means risk of selecting an inappropriate sample. Risk of selecting an inappropriate sample, that risk we simply call it as what? Sampling risk. But when I have to say the technical definition, they say that sampling risk is defined something like this. The conclusions which I have drawn by performing audit procedures on the sample would be different if I perform audit procedures on entire population. So like for example, from the entire population, I have taken a small sample. So I performed audit procedures on this sample, I got to know some conclusions. If I perform audit procedures on the entire population, my conclusions would have been different. Like I performed the audit procedures on the sample, I did not find any material misstatement. But if you have performed audit procedures on the entire population, you would have identified material misstatement. That means your conclusions are changing. No, whatever your conclusions are there by performing audit procedures on the sample, the conclusions would have been different if the entire population is subjected to same audit procedures. Nothing but in simple terms, what? Risk of selecting an inappropriate sample. And this sampling risk is going to have an impact on test of controls also. It is going to have an impact on test of details also. Very important, pay attention. So first, how it is going to impact our test of controls. So assume that I have taken an entire mass of internal controls, entire population. From that population of internal controls, I have selected the sample. Now I perform test of controls on this internal control sample. I am not able to find any weakness in the internal controls in the sample which I have selected. What conclusion I will make? Internal controls are strong. On the basis of this, what decision I will form regarding substantive audit procedures? I will take a decision that I will try to perform less substantive audit procedures. But in fact, if you would have performed audit procedures on the entire population of internal controls, there are actually weaknesses in the internal controls. Internal controls are weak actually. You should have performed more substantive audit procedures. So when more substantive audit procedures are appropriate, you are performing what? Less substantive audit procedures. Because of this, which aspect of the audit will be affected? Will it affect efficiency or effectiveness? See, efficiency means doing the work in a quick manner. Effective means doing the work in a qualitative manner. So where more substantive audit procedures are appropriate, you are performing less substantive audit procedures. Because of this, what will be impacted? Will efficiency be impacted or effectiveness be impacted? Effectiveness will be impacted. That means your audit work will be less qualitative, whereas it will be efficient. Why will be efficient? You will spend less amount of time. No, but you are not doing the work perfectly. So what will be impacted? Effectiveness will be impacted. This risk we call it as risk of over reliance. That means you are overly relying on internal controls on the basis of sample when in fact they are not that reliable. Understood? And this risk of over reliance is going to affect my effectiveness of the audit. Next one, the other thing will be once again entire large mass of transactions of internal controls. From that I have selected one small sample. My bad, whatever weakness is there, that has come into my sample of internal controls only. From the sample perspective, it is looking a very big weakness. So what decision I will form? Internal controls are weak. On the basis of that, what decision I will take? More substantive audit procedures I will perform. Whereas in fact, if you have performed the audit procedures on the entire population, that weakness is not at all material from the entire population perspective. Weakness is there, agreed, but from the entire population perspective, that is not at all material. So what should have been your decision? Internal controls are strong actually there. What should have taken decision regarding substantive audit procedures? Less substantive audit procedures. This should have been appropriate decision. But on the basis of the sample, you have taken the decision that I will perform more substantive audit procedures. So when less substantive audit procedures are appropriate, I am performing more substantive audit procedures. Which aspect of the audit will be affected? Efficiency or effectiveness? Efficiency will be impacted. Why? Because you are spending unnecessarily more amount of time on that. You will do the work perfectly, but you are spending more time. So that's why efficiency will be impacted. This we call it as risk of under reliance. You are under relying the internal controls when in fact they are strong. Similarly, it is going to have an even impact on test of details also. Here the conclusions are a bit easier like the above previous one. So take entire population of transactions. From that I have taken a sample. In my sample I did not find any material misstatement. No material misstatement I was able to find. What opinion I will give? Unmodified opinion I will give. But if you have performed entire audit procedures on the population, you would have identified misstatement. So what opinion you should have given? Modified opinion. When modified opinion is appropriate, you are giving unmodified opinion. Will there be audit risk here? Yes, there will be audit risk here. We call this risk as risk of incorrect acceptance. You are incorrectly accepting that there are no material misstatements. Whereas if you look into other way around, entire population, taken a sample, in that only you got one misstatement. From the sample perspective, it is looking material. What opinion you will give? Modified opinion you will give. But if you look it from the entire perspective, it is not at all material. You would have given unmodified opinion. This is appropriate, but you are giving modified. Will there be audit risk here? There will not be any audit risk here. This is what we call it as risk of incorrect rejection. Risk of what? Incorrect rejection. This is how sampling risk is going to have an impact on test of controls also, and even it is going to have an impact on test of details also. Clear everybody? Now next most important aspect is projection of the misstatement. How we are going to project the misstatements. So projection of the misstatement means if I am able to find in the sample these many number of mistakes, how many mistakes could be there in my entire population? That estimation we call it as what? Projection. So projection has to be done not on the basis of number of misstatements. Projection has to be done on the basis of value, on the value of the misstatements. Like one simple example, we will try to close it in some 2-3 minutes. So just let us quickly try to understand it. So assume that total population is some 10,000 transactions number. Out of this 10,000 transactions, I have taken a sample of 1,000 transactions, sample number. And out of that sample number, I am able to find out 20 misstatements. How many misstatements? 20 misstatements. Now what I need to determine first is value of the entire population I need to determine. Assume that value of the entire population is some 1,000 crores. Then I need to determine what is the value of the sample. Assume that value of the sample is some 250 crores. I need to determine what is the value of this misstatements also. So what is the value of the misstatements? Let us assume that value of the misstatement is some 40 crores. Now before doing the projection, I need to do one more step. What I need to do is, out of the misstatements I have identified, out of the value of misstatements, I need to determine how much is anomalous misstatement, how much is non-anomalous misstatements. First of all, what do you mean by anomaly? Anomaly means it has no chance of repetition, unique misstatement that can't happen in the rest of the items. So first you need to identify what is the anomalous misstatement, what is going to be non-anomalous. For example, I came to know that out of this 40 crores of misstatement, some 3 crores is anomalous. That means it has no chance of repeating in the rest of the population. It is a one-time mistake. Rest of the 37 crores is what? Non-anomalous. It is of repetitive in nature. Now when I do projection, am I required to do the projection for 40 crores total misstatement? Am I required to do the projection for anomalous misstatement 3 crore? Or am I required to do the projection for non-anomalous misstatement 37 crores? For what I am required to do the projection? Only for non-anomalous. Why I should not do projection for anomalous? Why? Because you yourself are telling it is not repetitive in nature. So that's why we should not do projection for anomalous once again. So now how I will do the projection is, if for an entire population value of 1,000 crores, if for a sample value of 250 crores, there is a non-anomalous misstatement of 37 crores. How much non-anomalous misstatement could be there in 1,000 crores? This math you have to do, and the resulting figure will be projected misstatement. To that, we have to add back anomalous misstatement with projection or without projection? Without projection. What is the anomalous misstatement in our example? 3 crore. Assume what will be the value here? 140. Okay, take it 150, somewhere around, round off 150. So now the total projected misstatement will be 153 crore rupees. Now this I will compare with the materiality levels. If it is more than the materiality level, I will modify. If it is less than the materiality level, I will not modify my opinion. So this is the procedure for projection of the misstatements. And they say one more thing there. for test of controls, we should not do explicit projection. Why? Because sample deviation itself is going to be population deviation. For test of controls, we don't require explicit projection. Why we don't require explicit projection? Why? Because sample deviation itself is population deviation. Why? Because if there is a problem with the internal control, no matter you pass 1000 transactions through it, no matter you pass 1 lakh transactions through that internal control, output is going to be same. So that's why for test of controls, we don't require any explicit projection. Now we will be having one more last question regarding evaluation of sample results. See, if I go into details of that, we will spend rest of the 20 minutes also in that question only. So I will not do that. What I will try to do is some key content I will say which can be tested in the form of true or false statements. Okay, so please try to pay attention to that only. I'm not going to explain this evaluation in a much more detailed manner. Why? Because it will easily eat away some 15 to 20 minutes only on that evaluation of the misstatements. So just let us try to some 3-4 sentences will be there which are important from the true or false perspective. Just I will revisit that. That's all. So they say that if the projected misstatement exceeds the tolerable misstatement, then the sample does not provide you a reasonable basis for the conclusions. This is what one point they say. If the projected misstatement, whatever you have done, so anyhow, let me open that material. That statement also I will show you so that you can read later. Yeah, this one. So in this, I will say this thing, 4th point, 5th point and 6th point, just we'll try to revisit them once and then proceed with the next chapter. 4th point, they say that when the projected misstatement plus anomalous misstatement, if they exceed tolerable misstatement, like for example, I am willing to tolerate only 100 crores of mistake. I am willing to accept the risk of 100 crores. But I came to know that my projected misstatement itself is some 120 crores. So my projected misstatement is more than tolerable misstatement. In such a case, sample do not provide you with the reasonable basis for conclusion. That means if you evaluate the entire population, you would get even more misstatements. That is what the meaning of sample do not provide reasonable basis. Next one, the closer the projected misstatement is to tolerable misstatement. In the previous point, they told already exceeded. Now what they are telling? It is coming closer. Like for example, my tolerable misstatement is 100 crores. But my projected misstatement is 95 crores. It has become very close to tolerable misstatement. Then here there is a assumption that since the projected misstatement has come closer to the tolerable misstatement, if I perform audit procedures in the entire population, my actual misstatement could even go beyond my tolerable misstatement. So that's what they say there. The closer the projected misstatement plus anomalous misstatement is to tolerable misstatement, the more likely that actual misstatements in the population may even go beyond my tolerable misstatement. Why? Because on the basis of sample only it is coming closer. So if I evaluate entire sample results, it might even go beyond my tolerable misstatement. And one more sentence, what they say is, if the projected misstatement is greater than auditor's expected misstatement, which is used for determining the sample size, then you can conclude that there is an unavoidable sampling risk. That means, for example, you thought that there is a total value of some 10,000 crores of purchases is in front of you. You thought in this 10,000 crores of population, I'm expecting only 100 crores of mistake will happen. Even if it happens, only 100 crores of mistake will happen. Since I expected only 100 crores of misstatement, I verified only 3% of the sample size. But on the basis of this 3 sample, when I did the projection, my projected misstatement has itself become 150 crores. So my projected misstatement is greater than expected misstatement used by the auditor in determining sample size. Now you tell me, have you made a correct assumption there? Wrong assumption there. Wrong assumption. You should have expected some more misstatement. If you had expected some more misstatement, you would not have gone with 3% of sample. You might have gone with some 10% of sample size. Then you would have got to know more material misstatements. Understood? I know it will be going beyond, but just try to stick to that only. If we take up this entire answer, we are not going to complete whatever we have expected. Clear? So just try to memorize, just try to understand, try to think about it on your own. Try to assign some values and do the comparison, like the way I did tolerable misstatement 100. If it has exceeded means 120. So try to assign the values and try to read it. Then you will be able to make some valuable conclusion out of it. Clear everybody? So with this we have covered audit sampling completely. Clear? So now we will be starting with analytical procedures. So let us now start understanding about analytical procedures. So, and the related standard which is giving us guidance regarding this matter is SA 520 is the related standard which is giving us guidance regarding analytical procedures. Fine. So we have already seen the meaning of this term analytical procedures as a part of our earlier discussion. What we have told that it involves study of relationship between financial and non-financial information to evaluate whether the financial information is correct or not. But we need to filter that definition even more. So it doesn't involve only studying relationship between financial item and non-financial item. It even involves study of relationship between two financial items also. Analytical procedures, it doesn't only involve study of relationship between one financial and one non-financial. It even involves a study of relationship between two financial items also. And you have a dedicated chapter in your financial management, ratio analysis. See, that ratio analysis chapter is full of studying relationship between two financial items only, like gross profit ratio, net profit ratio, and even fixed asset turnover ratio, creditors turnover ratio, debtors turnover ratio, fixed asset turnover ratio. So that chapter is nothing, debt service coverage ratio. So that chapter is nothing but full of studying the relationship between two financial items only. So like take for example, I have taken some two financial items like net profit percentage. When I calculate net profit percentage, I am actually studying relationship between two financial items. What are they? Net profit and turnover of the company. So I calculated net profit. It is 15%. Done. I completed my analytical procedures? No. Studying the relationship is only starting point. I will study the relationship. After that, what I am supposed to do? Comparison. What I am supposed to do? Comparison I am supposed to do. With what I am supposed to compare? I can do different kinds of comparison. I can compare with the prior year's data. I can compare current year's net profit ratio with last year's net profit ratio. I can compare with my competitors' data. What is my competitor net profit percentage? What is my net profit percentage? I can compare this net profit with industry average net profit. I can compare with the projected results, like I can compare with the expected results like budgets. So like this, multiple kinds of comparison I will do. Okay, I did the comparison. Current year net profit is 15%. Last year's net profit is 20%. I compared. Over. Analytical procedure? No. By doing that comparison, I need to find out deviation. Is there a deviation here? Yes, 5% deviation is there. Since I got 5% deviation, okay, these financial statements contain a material misstatement. That's all? No. After identifying the deviation, the next step which we are supposed to do is investigate that deviation. Find out whether that deviation is because of genuine and valid reasons, whether that deviation is because of material misstatement. Why? Because sometimes deviation can happen even because of valid reasons also. Like for example, some uncertainty happened, like COVID effect is there. That's when net profit could have gone down. So whatever it could be, when you find deviation, you should not immediately jump to the conclusion that there is a material misstatement. You need to investigate that further. By that you will come to know, is this deviation because of a valid reason or this deviation is because of some material misstatement. So that you need to find out. So this is what will be involved in the analytical procedures. Studying the relationship, doing the comparison, identify the deviation or fluctuation, try to investigate that deviation further and find out whether there is any material misstatement. Next one. Even I can study relationship between one financial item and one non-financial item also. We have a lot of examples here, like salary cost and number of employees. Both are containing relationship. If the number of employees increases, salary cost should increase. Or you can say revenue per person. We will calculate some ratio called RPP, revenue per person or profit per employee. How we will calculate it? Total revenue divided by number of employees, or number of electricity units consumed with electricity expenses. So like this, we will take one non-financial item, study its relationship with financial item, and we see whether that relationship is consistent as it should be. If I find the relationship is inconsistent, there also I will try to investigate that further and find out whether that inconsistency in the relationship is because of valid reason or is it because of some material misstatement. So this is what I will simply do it in my analytical procedures. Now, if we talk about purpose of analytical procedures, what is going to be the purpose of analytical procedure? See, broadly speaking, the purpose of analytical procedures is two. And if you remember in the earlier discussion, whatever we had, analytical procedure can be used as substantive audit procedure. It can be even used as risk assessment procedure also. Like in the morning session when I was revising risk assessment and internal control, I told you that risk assessment procedures includes three things: inquiries, observation and inspection, and analytical procedure. So I can perform analytical procedure as a substantive audit procedure. I can perform analytical procedure as a risk assessment procedure. When I am using it as a risk assessment procedure, why I will use it? Risk assessment procedures, what I do? I try to identify the risk of material misstatement. Or I can use it as a substantive audit procedure. What I try to do in the substantive audit procedure? I try to obtain sufficient appropriate audit evidence. So that's why analytical procedure is only having two purposes. If used as a risk assessment procedure, it will help me to identify risk of material misstatement. If used as a substantive audit procedure, it will help me to identify unusual circumstances or material misstatements. It will help me to find it out. That is what the purpose. The purpose is that only. Ultimately, the purpose is that. So, like if you read the answer also, I think if I'm not wrong, it is question number 3. So even if you read this also, analytical procedures, what is the purpose of analytical procedures? See, first and second points are just added for scoring the marks. The ultimate purpose is mentioned in the third and fourth point only. Like if you observe, it is important to note that analytical procedures will help in the existence of unusual transactions, ratios, trends. Nothing but it will help us to find out material misstatements when used as substantive audit procedure. Or it can also be used to find out risk of material misstatement when used as risk assessment procedures. The first and second point are nothing but they have added for getting the score. Like for example, if they ask you what is the purpose of analytical procedure and they are expecting 4 marks from you. If you write only the last 2 points, you will not get the score. So you need to add some extra points. No, that's what they add. So these first and second points also we know. Analytical procedures use comparisons and relationships to know whether account balances are correct or not. So we are going to study the relationships here. And in the second point, what they say is we can do inter-firm comparison also, intra-firm comparison also. Inter-firm comparison means we are going to compare with other entities like competitors, industry averages. Intra-firm comparison means current year data compared with the prior year data. That is the intra-firm comparison. But ultimately purpose is 2. And they say objective of the standard as per SA 520. What SA 520 is asking the auditor to do. And why we use analytical procedure. So we use analytical procedure to obtain sufficient and appropriate audit evidence when used as substantive analytical procedure. And the standard says one more thing. They are asking you to perform analytical procedures at the conclusion of the audit also, close to completion of the audit. Why, sir? To understand whether the company's financial statements are as per your understanding which you had at the beginning of the audit or not. Like if I came to know that entire IT industry is falling and if my client is one of the IT company, even what should happen to my client also? It should also have seen some downward pressure. So at the end of the audit, close to completion of the audit, we can perform analytical procedures to know whether the financial statements are as per auditor's understanding or not. See, you can do one thing. If they ask you what is the purpose of analytical procedures, you can combine second answer, third answer and write it. One point is common. Analytical procedures will help us to obtain sufficient and appropriate audit evidence. Then you write, it can be even used as a risk assessment procedure for identifying risk of material misstatement. Add one more point there. It can be even performed at conclusion of the audit to know whether the financial statements are as per auditor's understanding or not. Try to combine both the answer. Remember one answer, even if they ask you objectives of the auditor as per SA 520, or even if they ask you what is the purpose of the analytical procedure, write the same 3 points to avoid the confusion. Clear everybody? So this is regarding question number 2 and question number 3. So now let us see what else we are supposed to cover. Now question number 4 is also very simple. What is the timing of analytical procedures? When we will perform analytical procedures? The above answer says it all. If we are using as a risk assessment procedure, at the planning stage we are using. If we are using as a substantive audit procedure, at the testing phase you are using. And even the standard is telling use it at the conclusion of the audit. That means at the completion phase also we will use. So we are going to use it at the planning stage, at the actual testing stage, and even we are going to use it at completion phase of the audit also. And they will specifically mention how we will make use of the analytical procedures at the closing phase. So how we are going to make use of it means for understanding about the entity and its environment, and also to identify risk of material misstatement. Why? Because if we identify risk of material misstatement, we will be able to betterly plan our nature, timing and extent of the audit procedures. Clear everybody? So this is regarding the first 4 questions. Next they will say something regarding what do you mean by substantive analytical procedure. What is the difference between analytical procedure and substantive analytical procedure? Don't say substantive. Tell me what is the logical reasoning there. What is the difference between analytical procedure and substantive analytical procedure? Nothing but analytical procedures can be used as substantive audit procedure also, risk assessment also. If you are using analytical procedure as a substantive audit procedure, that we call it as what? Substantive analytical procedure. Nothing but what they try to say here is substantive audit procedures involve test of details also, analytical procedures also. So analytical procedures are one of substantive audit procedures, which we call them as substantive analytical procedures. Whether auditor has to use test of details or analytical procedures, is there any hard and fast rule? No. This who has to decide? Auditor himself has to decide. Using what? His professional judgment. Sometimes he will feel only test of details will be suitable. Sometimes he might feel analytical procedures might be suitable. Sometimes he might decide a combination could be suitable. Who has to take that decision? Auditor, on the basis of professional judgment. But they say one more thing here. Before you take a decision, before you want to make use of analytical procedure, first ask the management data is available or not. Why? Because the most important thing for performing analytical procedures is availability of data. If data is available, then you perform analytical procedures. If they say that data is not available, try to stick to test of details. And also inquire whether management made any analytical procedures for their decision making. Not just you, even company also wants to know comparisons. Even they also want to know whether from last year to current year the profit is increased, if it is increased because of what reason, if it is decreased because of what reasons. Even management also do this for their decision making. Inquire whether management did any of this analytical procedures for their decision making purpose. If yes, management have done it, can I make use of management's information for my analytical procedures? Yes, you can do it, provided you have to check for validity, authenticity of the data, whether that data prepared by the management is correct or not. You check it once, then you can comfortably make use of that analytical procedures prepared by the management. Then they say few more factors which we have to keep in mind while deciding whether we can perform analytical procedures or not. As I have just now told you, availability of data. If data is available, we will perform analytical procedures. If the data is not available, we might not perform analytical procedures. Just availability will not be enough. Disaggregation. To what extent you can separate the data? For example, if you have one consolidated entity like Reliance Industries Limited, we don't have any close source to compare with Reliance Industries Limited. On the other hand, if you are able to segregate business-wise information, so if I am able to segregate out of the entire Reliance Industries Limited, what is the petroleum data alone? I have so many sources to compare. Like I can compare with Indian Oil Corporation, ONGC, like that I can compare. If I am able to segregate only telecom business data, I have so many sources to compare. Like Vodafone Idea, I have Bharti Airtel. So like that, if the information is separatable, segregatable, then only I can perform analytical procedures. If I am not able to segregate it, I will not perform analytical procedure. It depends on account type also. Some items will be more suitable for performing analytical procedures like P&L items. Some items will not be suitable for analytical procedures like research and development expenditure. So it depends on account type also. It depends on source from which you are getting the information. Source means nothing but reliability. If the information is more reliable, analytical procedures will be more comfortable. If the data is not reliable, then analytical procedures might not be that reliable. And it even depends on predictability. Some items are more predictable, like gross profit is more predictable than when compared with the net profit. So if more the predictability is there, better suitable for analytical procedures. Less the predictability, less suitable for analytical procedures. It also depends on nature of assertion. Like analytical procedures might be suitable for obtaining evidence regarding completeness or valuation assertion. But I can't know existence by doing analytical procedures. Whether the asset is there or not, I want to know. Can I use analytical procedures for that? No. But I want to know whether all the assets are recorded or not. Then analytical procedures might be suitable. It also depends on assertion. And it even depends on what can go wrong. Nothing but indirectly risk of material misstatement. I will try to use analytical procedures when the risk is lower. When the risk is very, very high, then analytical procedures alone will not help me out. There I should put more emphasis on test of details. So whenever the risk is lower, those areas might be very suitable for performing analytical procedures. If I expect the risk is very, very higher, then I can't rely only on analytical procedures. I have to keep in mind even test of details also. I should put more emphasis on test of details. Understood? So we will stop it here. Still we have a lot more discussion regarding analytical procedures. I don't want to rush through the things in this 5 minutes and complete it in a hasty. So we will start it at after the break, 4:30. Okay? Right. Okay, shall we start? See, before proceeding with further things, people are asking list of important chapters. Which chapter should be prepared so well? Uh, See, I might have already told you in the classes, but for the common knowledge of each and everybody, let me tell you once again. So I'm going to tell you the chapters which you should not leave it at all. So once again, I say this term repeatedly. I will never ever say which chapters can be taken as choice. I'm going to only say what which chapters you should not take as a choice. So, and simply if you observe, you can follow the pattern whatever I have followed, except a slight change. So the chapters which you should not leave at all are nature, objective and scope of audit, company audit, audit reporting, audit documentation and evidence, and the standards. Not all the standards also, specifically 4 standards, 501, 510, 505, 580. These 4 standards specifically. And after that, audit sampling, analytical procedures, audit in an automated environment, and one more thing, fraud and responsibilities of auditor. These chapters should not be coming into your choice list. Once again, I am repeating: nature, objective and scope of audit, company audit, audit reporting, audit documentation and evidence with 4 standards. What are those 4 standards? 501, 510, 505, 580. Along with that 4 simple chapters: audit sampling, analytical procedures, audit in an automated environment, fraud and responsibilities of auditor. Okay. And also the last 2 chapters, items of financial statements, various entities. This I will not ask you to prepare. Fine. Okay. Shall we proceed further? Yeah, I was telling one more thing, no? That last 2 chapters, audit of items of financial statements and audit of various entities also will be covered. Also has to be covered, but don't try to prepare fully. Don't try to by heart that last 2 chapters. It should be simply like a story reading. That's all. Just give a novel reading once. That itself will be enough. No need to by heart or put all your effort on that last 2 chapters. Just give a quick glance once. That itself will be enough. Understood? So these are what the list of important chapters. You have to stick to this. Shall we proceed now? Right. So let us start once again from wherever we have left out. So where are the things that we have actually left them out? So we have left it out that analytical procedures, somewhere in between question number 5, no, till question number 6 we have completed. So now let us try to understand from 7th question, which is regarding what are techniques available for performing analytical procedures. So broadly 4 techniques are available. What are that 4 techniques? So first one, they say when it comes to first one is trend analysis, then we have ratio analysis, then we have reasonableness test, and then we have structural modeling. See what will happen in the trend analysis. I will establish the trend of one particular item over a period of time. Like revenue, if you take, I will study how the revenue is growing or how the progress is making in the last 5 years. Like for example, I came to know that on an average revenue of the company is increasing every year at the rate of 20%. That is a trend. I will check whether in the current year also the account is moving in line with the trend or not. If last year 100 crores is the turnover, if I am seeing 20% annual growth rate, what should be the turnover in the current year? 120 crores. So this we call it as trend analysis, where we compare with the prior period's trend. And one more thing, ratio analysis. Ratio analysis is very simple. This purely involves a study of relationship between 2 financial items. Why? Because an individual item of financial statement is difficult to predict on its own, but its relationship with another item can be easily predicted. So that we call it as ratio analysis. Then we have reasonableness test. In the reasonableness test, we will not go to the prior period information. We will not even go back to study the relationship between 2 financial items also. We are going to take a financial item and study its relationship with related non-financial item. Understood? We will not go to prior period. We will not study relationship between two financial items. We will study we will take one financial item and study its related non-financial item of the current year only, like storage space with the quantity of the stock. So that is one example. Closing stock value versus storage space of the current year. So that could be one example for this reasonableness test. And then comes the last one, structural modeling. In the structural modeling, what will happen is these are some tools or softwares which are developed using statistical concepts, which will study the relationship between the data automatically and predict the outcome. But these structural modeling tools are not that widely used in the market because of the various complexities involved in that softwares. Why? Because it is not that easy for our chartered accountants to use the statistical softwares, and even it is very difficult for us to use the software only. So statistical software using is even much more difficult. So these are the 4 techniques available for performing analytical procedures: trend analysis, ratio analysis, reasonableness test, and structural modeling. So now next question we will have, which is, when we want to use substantive analytical procedures, it involves 4 steps actually. So those 4 steps are, actually that 4 steps are 4 separate questions which will be there later. When you want to make use of analytical procedures, it involves how many steps? 4 steps. Each of the step will be addressed in each of the rest of the question. So that 4 steps in performing analytical procedure are: first, determining suitability of analytical procedure for a given assertion. Second one, determining reliability of data. Third one, what we say is that what are the expectations that deviation resulted in the analytical procedure will result in a material misstatement. And the last step is investigation of deviations. So 4 steps will be there. Each and every step will be discussed in a detailed manner in each of the question. First one is what? Determining suitability of analytical procedure. Nothing but we have seen so many techniques now: trend analysis, ratio analysis, structural modeling, reasonable test we have seen. Out of these many techniques, which technique will be suitable for which item of financial statement? How you are going to decide? How we will establish suitability of analytical procedure for a given assertion? They simply say that who has to decide means auditor has to decide. Very straight away they will say which analytical procedure will be suitable for which assertion. This has to be decided by auditor using his professional judgment. That means he has to analyze, if I use which particular method, it will help me to identify the material misstatement. Like if I use trend analysis, will it help me to identify misstatement? Or if I use ratio analysis, will it help me to identify the misstatement? So that analysis auditor will do. He will use his professional judgment and decide, okay, this particular method will be suitable for me. And they say that sometimes a simple unpredictable model, unsophisticated predictable model, a simple unsophisticated predictive model can also act as a effective analytical procedure. Like if the sales of the company are increasing, what should have happened to the profit? Should have increased. So in order to know this, you need not be a chartered accountant. Even a layman also can understand it. So sometimes this kind of simple analysis will help us to identify big misstatements. Not in all the cases, but in some cases. And sometimes you have to do some more robust and sophisticated analytical procedures. But whatever it is, different kinds of analytical procedures will provide you with different levels of assurance. One key takeaway from that answer will be nothing, just they will want to drive one conclusion: which analytical procedure will be suitable for which assertion. That purely depends on auditor's professional judgment. That is the only point which they want to make here. Next one, they say we need to determine reliability of data. See, whether results of analytical procedures are correct or not, whether we can rely on results of analytical procedures or not, that depends on reliability of the data which you are using for performing analytical procedures. Whether results of analytical procedures, are they reliable? We can trust the results of analytical procedures or not. That depends on what? Reliability of the source data which you are using. So whatever factors which affects the reliability of source data, the same factors are even going to affect reliability of results of analytical procedures also. So what are those factors which affects the reliability of data? Very simple things they say. Like first point, they say it depends on source from which you are getting the data. Like if you are getting from a reliable external source, data will be more reliable. If you are getting it from non-reliable internal sources, data might not be reliable. If the data which you are using is not reliable, the results of the analytical procedures also will not be reliable. And second point, they say comparability. See, if you have close source to compare, then we can decide whether data is reliable or not. If we don't, if a company is engaged in unique business, like selling the customized products, like your name's getting engraved on the jewelry, or selling printed shirts with your logos, etc. So like this, if you have customized businesses, we will not have close source to compare. Since we don't have close source to compare, we will not be in a position to establish whether the data is reliable or not. On the other hand, if I have close source to compare, then I will be able to decide whether the data is reliable or not. So second factors which affects the reliability of data is comparability. Third one, it depends on nature and relevance of that information also, how related that data is for your information. Like for example, if the budgets are prepared keeping reliable estimates in mind, then budgets can be easily compared. But on the other hand, management is very vague in deciding budgets. Like for example, their last year turnover was hardly 1 crore and they are telling in the current year budget we will achieve 100 crores of turnover. So that budget is not that relevant for your comparison. So it depends on nature and relevance of the information. And one more last factor, it even depends on internal controls over the preparation of that data. If the internal controls which are operating over the preparation of that data, if the internal controls are operating effectively, then data generated also will be reliable. If the internal controls over the preparation of data are not working properly, even that results of analytical procedures, even that data also will not be reliable. So whether analytical procedures we can perform effectively or not, the second factor which we need to consider is reliability of data. That reliability of data once again depends on 4 factors. What are they? Source from which we are getting, comparability of that information, nature and relevance of that information, and internal controls over the preparation of that information. Clear everyone? Right. Now let us come to the third step, which is whether expectation developed using analytical procedure, will it help in identification of material misstatement or not? See, here the problem lies in understanding the question only. The moment we understand the question, answer will be very easy. See, assume for example, when I am doing analytical procedure, when I did the comparison, I got deviation. I came to know a huge deviation. Now, if I investigate this deviation, there are chances that I might find out a material misstatement. Or sometimes after doing all the investigation, I might come to a conclusion that till now I am doing the wrong comparison. That conclusion also I can come to. Once I come to know about deviation, for example, I did some comparison. I calculated some ratio. Current year it was 20%, last year it was 2%. A huge deviation is there. When I analyze that deviation further, there are chances that I might identify misstatement. Or sometimes even I can come to a conclusion that till now I am doing my analysis at a wrong place. That decision also I can come to. So what factors will decide whether my investigation of the deviation will help in a resulting of a material misstatement or my analysis is going wrong? It depends on what factors. Like for example, first point they say it depends on the accuracy with which you can predict the data. That means if you perform analytical procedures on more predictable data, and there if you got deviation, more chances that it will help in material misstatement. If you perform analytical procedures on less predictable data, there even if you get deviation also, even if you investigate further also, there are less chances that you will be able to identify a misstatement. Like one simple example, if I take gross profit. Take two companies which are belonging to same sector. Take automobile sector, Tata Motors and Maruti Suzuki. See, they sell the prices, they sell their cars at more or less same prices. They buy the raw materials also at more or less same cost. See, when all the direct expenses and sale prices are constant, their gross profit is more predictable or not. So when I compare the gross profit, Tata Motors gross profit is 30%, Maruti Suzuki gross profit is 40%. There is a 10% change. Now if I investigate that difference, 10%, there are more chances that I will identify a misstatement. Why? Because gross profit is more predictable. On the other hand, I calculated something called research and development expenditure. That means I calculated research and development as a percentage of total revenue. I came to know that Tata Motors is spending some 20% on research and development expenditure. Maruti Suzuki is spending only 2% on research and development expenditure. Now if I investigate further, you tell me there are chances of identifying misstatement or I am doing analysis at a wrong place. You are doing analysis at a wrong place. Why? Because research and development expenditure is a discretionary expenditure. If the company wants, they will spend it. If the company doesn't want, they will not spend it. Like I investigated further. I'm auditor of Tata Motors. I went to the management and told, hey, your competitor is spending only 2% of the money on research. Why you are spending 20%? What my client will say? My wish. I want to remain updated with the future. So I'm spending so much amount on research and development expenditure. So that means you are doing analysis at a wrong place or not? Why? Because research and development expenditure is not that predictable. So the first point is which affects whether the evaluation, whether the expectation will result in a material misstatement or not. The first point is what? Predictability. If you perform analytical procedures on more predictable data, more chances that deviation will result in material misstatement. If you perform analytical procedures on less predictable data, there are very less chances you will identify a misstatement, more chances that you are doing your analysis at a wrong place. And the second factor they say here, degree to which the information can be segregated. Degree to which the information can be segregated. This example I have also covered somewhere at the beginning. So like Reliance Industries Limited, if you take, we know that Reliance Industries Limited is there in multiple businesses. So many businesses is there. Out of the multiple businesses, the main business is petroleum business. Now I calculated gross profit ratio of entire Reliance Industries Limited and I am comparing that gross profit with Indian Oil Corporation gross profit percentage. I found a huge deviation. You tell me, if I investigate it further, will I find a material misstatement or am I doing analysis at wrong place? You are doing analysis at the wrong place. Why? Because Reliance Industries Limited contains multiple businesses. On the other hand, instead of comparing entire Reliance Industries Limited information, if I am able to segregate only petroleum based data, for the petroleum based data I calculate gross profit percentage. That if I compare with Indian Oil Corporation gross profit, there if I find a huge differences, now if I investigate further, there are more chances that I will identify a material misstatement. So it even depends on the degree to which the information can be disaggregated or separated. What is the third factor? They say it even depends on availability of information and reliability, which we already know. For example, your client's data, you have 12 months of data. Your competitor's data, you have only 6 months of data. Now, even on this data also, if you perform analytical procedure, you got a huge deviation. If you investigate further, will you identify misstatement or analysis at the wrong place? You are analyzing wrong place. Why? Because you are doing analytical procedures on incomplete data. If the data is fully available and on that if you have performed analytical procedure, there if you got deviation and if you investigate that deviation, there are more chances that will result in identification of material misstatements. Understood? So these three are the factors which will decide whether expectation developed using the analytical procedure will result in a material misstatement or not. What are the three factors? The degree to the accuracy with which information can be predicted, the degree to which the information can be segregated, and availability of the information, both financial and non-financial, and also its reliability. Clear, everybody? So now we will be having last step of performing analytical procedure, which is what? Investigating the deviations. How we will try to investigate the differences? By asking the management. If you go and ask the management, they will give you information. If the management is not giving me information or if they are not giving me valid information, then what I am supposed to do? Try to perform alternative audit procedures. If alternative audit procedures are also not possible, try to modify your opinion. That is how we are supposed to investigate. With this, we are done with the chapter analytical procedures also. Clear, everybody? Right. So now what shall we start? Audit of banks. Okay. Right. So let us start now. Audit of banks. I will not be covering the entire chapter, but I will take you through the key concepts, important concepts or conceptual things I will take you through. So this I will try to open the material and take you through the contents of the material. Fine. So first of all, they say about when it comes to audit of banks, first thing we need to understand what are the various kinds of banks. So when it comes to various kinds of banks, they say altogether 6 types of banks are there. Commercial banks, nothing but every bank which is engaged in acceptance of deposits and issuing of the loans, that we call them as commercial banks. Then we have regional rural banks. They are established exclusively to meet the needs of rural areas. Then we have cooperative banks, nothing but these are also banks which accept the deposits, give the loans, but not for each and every individual, but only for a group of people, that is their members. For their members only they will give deposits and loans. That we call it as cooperative banks. We even call them cooperative credit societies also, we can call them. Payments bank, this is a recent introduction done by the RBI. Like we have today Paytm Payments Bank. They will accept limited deposits and give you debit cards, but they cannot give any kind of loans or credit cards. Like example are Paytm Payments Bank. Then we have small development banks. These are the banks which provide financing activities only for infrastructural industries like IDBI, SIDBI, etc. And then we have small finance banks. They especially cater to the financial needs of this unorganized sectors or unserved sectors like handloom industry, etc. So they are going to meet only the requirements of small group of people, unserved sector or unorganized sectors. So depending upon the people they are serving, depending upon the areas they are having expertise, so banks are broadly divided under this 6 categories. Then they say next thing, regulatory framework. This you can go through, nothing but list of all the laws and regulations which are applicable for the banks. So this I am not taking you through once again. And the question number 3 is also very general question. Our banks, our Indian banking sector is regulated by one regulator. Who is that? RBI. How RBI will regulate that banking sector? By determining CRR, SLR. It will act as a banker's bank. It will give the banker's license. It will control the supply and control the money in the economy. And even it will ensure good corporate governance in the case of the banks, etc. They can even appoint additional directors, etc., etc. So this is how RBI will regulate the banking sector in our country. Then we have, what are the types on the basis of computerization? 3 things: fully computerized, partially computerized, non-computerized. Non-computerized banks which are still carrying out the transactions in a manual manner, these kinds of banks are not existing today. Partialized activities, only some transactions are computerized, majority are non-computerized. Fully computerized, all the transactions are happening through the system only with the help of this core banking solutions. Next, we have special points. So in the special points, first point they say accounts regularized near the balance sheet date. Nothing but those accounts with a few credits just close to the balance sheet date. And as an auditor, if you find any inherent weakness, that means if you are able to know that whatever credits which are there in this account are actually fake, you should insist the management to classify them as NPA. Then advances under consortium, nothing but a group of banks coming together and giving the loans, that we call it as consortium advances. And in the case of consortium advances, there will be a lead bank, there will be a member bank. And who will act as a lead bank? Whoever is having a bigger share, they will act as a lead bank. And when this consortium advances are given, if the lead bank is collecting the payment and the share is not getting transferred to respective member banks, still member banks will classify that account as NPA. So that's why there should be proper communication between lead banks and member banks, and they should make proper arrangements collecting their respective share on due dates. So that's what they try to say regarding advances under consortium. Then we have the next point, accounts where there is a erosion, reduction in the value of the security. So if the value of the security is reduced by, if there is a reduction in the value of the security, we have to either classify it as a doubtful asset, or we have to classify it as a loss asset. When doubtful, so we have to classify it as a doubtful asset if the realizable value of the security is less than 50% of the previously assessed value. Whereas when it has to be classified as loss asset, when the realizable value of the security is less than 10% of outstanding amount. The point which you have to pay attention here is, in the case of for doubtful advances, we will compare it with previously assessed value. For loss asset, we have to compare with outstanding amount in the borrower's accounts. Very important for MCQs and true or false statements. For treating it as a doubtful asset, we have to compare the current realizable value with previously assessed value of the property. For classifying it as loss asset, we need to compare the current realizable value with outstanding amount from that respective borrower. Next one, advances against NSCs, KVPs or term deposits. If you give these kind of deposits as security, you need not classify them as NPA provided subject to fulfillment of one condition. What is that condition? Adequate security, that is proper margin should be there. When we say there is a proper margin, when the value of the security is more than value of the loan, till that time that margin is maintained, you need not classify them as NPA. And also, if agricultural advances are affected, first of all, NPA norms for agricultural advances are going to be different. You cannot follow that 90 days overdue, etc. For agricultural crops, there is a separate NPA requirement. What are that NPA requirement? See, for that purpose, we classify the accounts into long duration crop, short duration crop. See, a long duration crop related advance will be classified as NPA when it remains overdue for more than one crop season. Whereas the short duration crop will be treated as NPA if it remains overdue for more than 2 crop seasons. And what do you mean by crop season? The time which is taken from sowing the seeds till the time of harvesting the crop, that we call it as crop season. And when a crop will be classified as long term and when it will be classified as short term? If it takes a crop season of more than 1 year, we classify it as a long duration crop. If the crop season is less than a year, we classify it as a short duration crops. And sometimes agricultural advances will be given, but they will be affected by natural calamities. Then respective banks have been given power to take the appropriate action. Like some banks take the power of extending the due date. Some banks will give a new loan and recollect this old loan and new loan at once. So like that, when agricultural advances are affected by natural calamities, power has been given to the respective banks to decide how they want to treat it. So if the bank has taken any rescheduled terms, now NPA has to be classified as per revised terms, not as per original terms. Simply assume that when the loan was given for agricultural advance, original due date was 31st of March. But that crop is affected by natural calamity. Now the due date has been extended. The bank has extended the due date up to 30th of June. Now in order to classify as NPA, we will treat that loan as overdue if it remains unpaid from 31st of March or 30th of June. From 30th of June. That means as per the revised terms, you have to take NPA treatment, not as per old terms and conditions. That is what they try to say in this F point. Now we will have one more point called advances to staff. Even bank can give loans to their staff also. But here the advances can be given in two capacities. The bank can give loan to their own staff in the capacity of a banker, or even they can give a loan in the capacity of an employer. See, one example of loan given in the capacity of a banker, housing loan given to the staff. See, the SBI, assume SBI bank. SBI's normal course of business is what? Giving loans. In the normal course of business, they give even housing loans also. So like that, they have given even housing loan to staff also. So this is a loan given in the capacity of a banker. Now, can you give me one example for loan given in the capacity of an employer? Salary advance. SBI will give salary advance only for their staff. If you go and ask a salary advance from them, they will say simply get lost. Right? So banks can give loans to their staff in the capacity of an employer, in the capacity of a banker. If they give the loans in the capacity of a banker, it should form part of your business loans and advances. If they are giving it in the capacity of an employer, it should be shown under other assets category. And the key observation from this point is, when the loan has been given to the employee in the capacity of a banker, will there be any special NPA norms or normal NPA norms only will be applicable? Normal NPA norms only will be applicable. That means if you are treating for outsiders, if it remains overdue for more than 90 days, if you are treating it as NPA, even if your staff also doesn't repay the amount for more than 90 days, then even my staff account also will be classified as NPA. Just because I have given a loan to my staff, special NPA norms will not be applicable. Normal NPA norms, whatever we follow for other clients, those NPA norms will be applied even in the case of our loans given in the capacity of a employer also. So these are the special points while conducting the audit of a bank. So then next thing they say, what are the securities, different types of securities, and what are the various modes of creation of security. See, on the basis of security given, two kinds of securities will be there. One is primary security, other one is going to be collateral security. Primary security refers to principal security or main asset which has been given as a security for the purpose of the loan. That we call it as what? Primary security. Whereas collateral security means additional. Like, you have gone for a bank loan. So you have asked from the banker, sir, I need a loan of some, I need some long-term loan. The company told, I will give my factory building as a security. That is the main asset. That we call it as what? Primary security. But the banker told, sir, okay, factory building we will accept, but that alone will not be enough. We need some extra security also. So the client gave the stock also as a security. Now this stock is a what? Collateral security. And if we talk about examples of assets which can be accepted as securities, hell a lot of examples we can give, like it could be taken as fixed assets, plant and machinery, current assets like stock, inventory, debtors, insurance policies, gold in the bullion or jewelry format, and even stocks and shares. So like that, so many kinds of assets can be accepted as security. And there are how many modes of creation of security? In the material they say there are 6 modes for creation of security. First one, mortgage. So when we use the term mortgage, when we give immovable property as a security. And this mortgage is of 2 types. What are that 2 types? Registered mortgage, equitable mortgage. What happens in the registered mortgage? We are going to sign one mortgage deed. So that we call it as registered mortgage. Whereas what do you mean by equitable mortgage? It involves just handing over original documents of the property to the banker till the time I repay the loan. That we call it as equitable mortgage. Then the next 2 modes of creation, pledge and hypothecation, both are used when movable properties are given as security. But what is the underlying difference between the two? We use the term pledge where the possession is transferred to lender. Like gold loans. When we take a gold loan, the banker will not let us keep the jewelry with us. We have to deposit that jewelry with the banker. This is a pledge. Whereas hypothecation, neither possession nor ownership, nothing will be transferred to the lender. Like I have told you in the Caro point that stock is given as a security. When you give stock as a security, stock will not be given to the borrower. The stock will not be given to the lender. The stock will be still lying with that business only. This is what we call it as hypothecation. Then next comes assignment. What do you mean by assignment? When we use the term assignment, when we want to give actionable claims as a security, like our debtors, LIC policies, if we want to give them as a security, then we use this term called assignment. Then they say right of lien, nothing but retaining the possession of the goods and realizing the proceeds from them if the person is not paying the loan. And the last one, set off. Set off means the bank can set off one asset against one liability. Like you have taken a loan from the bank, you did not repay, but with the same bank you are having FD. Now what the bank can do? They can adjust your FD against this loan. And for this purpose, all the branches will be treated as same entity, and even this right can be exercised against time barred debts also. But one important condition, accounts should be in the name of same person, and even accounts should be, the person should be having a same capacity in both the accounts. Then only set off can be exercised. So these are the various modes of creation of security. Then they say something related to drawing power. What is this? Pen is not writing. So this is something regarding drawing power. First, what do you mean by drawing power? The amount in what is the amount which can be maximum withdrawn from the short-term facilities like overdraft limit and cash credit facilities. There they will give you one limit called sanction limit. Less than that sanction limit, they will put one more limit called drawing power. So like if you have taken a loan of 10 crore rupees, the banker will told, sir, I will sanction you 10 crore rupees. But you cannot draw the entire amount. You can utilize only 8 crore rupees of amount. Now this 10 crore rupees will be the sanction limit. 8 crores rupees will be the drawing power. And they say various things which we need to check as an auditor while we are verifying the drawing power. Like for example, bank's duties. What bank has to do? Bank has to ensure that all the accounts should be kept both within drawing power and also sanction limit. None should be exceeded. And also if any account by mistake, if it exceeds, in the today's environment it will not happen. Why? Because system itself will place a stop. If you want to even exceed the drawing power also, system itself will not permit. If by mistake, if any account exceeded drawing power or sanction limit, it should be brought to the notice of head office or the management regularly. And also on what basis you will determine the drawing power? On the basis of your current assets like stock. And also on the basis of recent stock statement, drawing power should be updated. And also considering difficulties of large borrower, RBI has given instruction that the stock statement should be received at least once in every quarter. No stock statement should be older than 3 months. Once in every 3 months, stock statement should be submitted, and on the basis of that recent stock statement, the banker will calculate your drawing power. Either increasing or decreasing will be done on the basis of your stock position. And also as an auditor, what we need to check? We need to check whatever documents which are submitted by the borrower for the purpose of loan. And also I have to check stock audit has been conducted in some circumstances. When stock audit has to be conducted? when the funded exposure, that is when actual amount utilized in the OD facility is more than 5 crore rupees, they're just receiving the stock statements alone will not be enough. Stock audit also has to be conducted by management of the bank. So I need to check whether that stock audit has been conducted or not, whether any of the stock auditors are giving any wrong negative comments regarding that stock audit which has been done. So this is what auditor's duties and stock audit related matters. This is how we are supposed to verify the drawing power in the case of banks. Next one, they say about I think engagement team discussion. No, provisions for appointment of an auditor. I think this you can handle. I did not take you through this. Nothing but they will say who will appoint, who has to appoint. That you can take it up. Nothing. My involvement is not required here. And next question is about engagement team discussion. Nothing but while conducting the bank audit, all the engagement team members should have a discussion at the beginning of the audit. And what matters they will try to discuss? Not the lunch, breakfast and dinner. What they are supposed to discuss in that engagement team discussion is what are the errors that are more likely to occur, or what are the errors which have already happened in the prior years, and methods by which fraud can be committed in the bank. And also they should discuss the importance of maintaining professional skepticism, and also how you have to respond to the risk and need to remain alertness for the frauds. So these matters are required to be discussed in that engagement team discussion, which will generally happen at planning of the audit. And what is the advantage of having that discussion at the beginning of the audit? If you have the discussion, it will provide an opportunity for experienced team members to share their knowledge and insights with the rest of the team members. Why? Because my engagement team might not contain all the experienced people. There can be some new article assistants which might be their first audit. So if you conduct team discussion, what will happen is it will provide opportunity for experienced team members to share their knowledge with less experienced team members. And also it promotes better understanding among all the members of the engagement team regarding what procedures they have to perform, how they have to take further this audit. So these are the advantages because of which engagement team discussion will be conducted in the case of bank audits. And practically speaking, not just in the bank audit, in every audit we will generally have one engagement team discussion at the beginning of the audit. Next one, write a short note on conducting a bank audit. Nothing but this they will say entire things which you will do in the audit. This question is not that important from the examination perspective. Only the last two things are important: Basel III framework and stress testing. So nothing but RBI has made mandatory for each and every bank to implement the stress testing framework. See, stress testing framework means nothing but a set of guidelines given by RBI which need to be followed by each and every bank. What are that guidelines? Not relevant for our discussion, but just we have to remember that every bank has to follow stress testing framework. As an auditor, I need to check whether my client bank is complying with that stress testing framework or not. That I need to check. And similarly, we will have one global framework also. Stress testing framework is an India level framework, whereas Basel III framework is a global framework. Basel III framework is also nothing but set of rules and regulations which banks has to comply for their effective functioning. So like that, one Basel III global framework is there which is given by a committee called BCBS. I need to check whatever has mentioned in the Basel III framework, whether that is also complied with or not. And also I need to go through audit reports of others, like I have to check previous year's auditors report, inspection reports from RBI, inspection reports from head office, internal audit reports, concurrent audit reports, like this. Whatever audit reports are available with that particular bank for which I am doing, go through all that audit reports and try to find out whether any of these auditors are giving any negative comments regarding advances. Next one, how you will, what and all things you will try to verify regarding advances of a bank. First they say for all the large advances you have to verify completely. Whatever other than large advances are there, that you have to verify on sampling basis. Sir, how can I conclude which advance is a large advance, which advance is a other than large advance? They say one general instruction which is not mandatory, just guidance they have told. What guidance they have told? An advance may be treated as large advance if the year-end balance is in excess of 2 crore rupees or 5% of aggregate year-end advances. If it fulfills that criteria, then we call that as large advance, and all the large advances should be verified completely. Whatever other than large advances are there, that I will try to verify on sampling basis. And even loans given by the banks can be divided under two categories: funded loans non-funded loans. What do you mean by funded loans? Which involves actual outflow of funds from the banker. Like housing loan, if you take, housing loan involves outflow of funds from the bank. That we call it as funded advance. What do you mean by non-funded advance? Which doesn't involve any actual outflow, like bank guarantee or this letter of credit. When you take a letter of credit, banker will not give you actual money. He will just give you a what? Guarantee. Even those kind of advances will come under non-funded advances. So whatever may be the advance, what are the common points I need to check? Some preliminary examination you have to do, which is nothing but the bank, before giving the loan to the customer, they need to check credit worthiness. What do you mean by credit worthiness? Whether the customer is in a position to repay the loan or not, bank should determine. And also bank should be given with proper approval, sanction. It should not be like you went to the bank, asked a clerk, sir, give me 10 lakh rupees of loan. He has taken, he's in the counter, he is having money, he has taken some 10 packs and he has given to you. Sir, go and enjoy. It should not be like that. Every loan should be given after getting approval from concerned manager. Check whether there is a approval or not. And all the documents are executed or not. Like loan agreements, all these things are properly signed or not, that I need to check. Next one, with respect to security, what you have to verify? Security should be registered in the name of the bank. If the shares and securities are accepted as a security, then that need to be transferred in the name of the bank at the time of taking the loan only. And also margin should be always maintained, not just at the beginning of the loan. Throughout the tenure of the loan, margin should be there. What do you mean by margin here? The loan, the security amount should be higher than loan amount. That margin should be maintained continuously. And also in case of goods in the possession of the bank, like for example, if you have taken pledge, you have taken jewelry from the customer and gave the loan, whether that jewelry is still there with the bank or not, at periodical intervals they have to do physical verification. And some points with regard to drawing power. Drawing power register should be updated every month. Here you have to be very specific, guys. They might test you in the true or MCQ question. Drawing power register should be updated every month, but stock statement can be received once in 3 months. Both are different. We can receive the stock statement once in 3 months, but drawing power register should be updated every month. And also we have to see that all the accounts should be kept within drawing power and sanction limit. And if any account exceeds the drawing power or sanction limit, it should be brought to the notice of management. So these are the things which I need to check regarding loans and advances. Sometimes even they will ask the question, what internal controls bank should have regarding loans and advances. For that also you are supposed to write the same answer. Why? Because whatever points we have read now, those are also can be treated as internal controls which a bank should have. So even if they ask you the question, how you will obtain audit evidence regarding advances, or even if they ask the question, what internal control bank needs to implement regarding advances, for all the things we are going to write the same points. Clear everybody? Now. So when it comes to incomes, we know first one general policy, they say whatever income which exceeds either 1% of total income, or if it exceeds at least 1% of net profit before taxes, that should be recognized on accrual basis. If any expense does not meet this criteria, that is if it is less than 1% of the total income also, and it is less than 1% of net profit also, that income can be recognized on cash basis. That means power has been given to bank to decide. Next one, and income recognition, we know if the account is classified as NPA, we need to recognize only on cash basis. But however, there is an exception. If the loan has been taken on the basis of term deposits, NSCs, KVPs, IVPs, then they need not be classified as NPA, and even income also we can keep on recognizing. Next one, reversal of income. We will not just stop accruing of further income. Whatever income which is already recognized but not yet realized. If realized, okay, but income is recognized but not yet received, that should be even reversed also. What should be done to that income? That should be reversed back. And even though we reverse it, even though we stop accruing it, but for control purposes, we will keep that in a separate account called memorandum account. And in case if you receive partial recovery, that means some one account has gone full and final settlement you have received. So you have received a bulk money. Sir, out of that bulk money, am I required to treat it as a collection of principal, or am I required to treat it as a collection of interest? So how it needs to be decided? Generally agreement will be there. In that agreement it will be mentioned how it needs to be apportioned. You have to follow that. If that particular customer's loan agreement is silent on this matter, then whatever standard policy you are following for other loan agreements, that need to be consistently applied for this particular customer also. And In case as a part of partial recovery, if you are treating the receipt as receipt of interest now, you would have already reversed it or you would have not accrued it earlier. Now we have to recognize now. Why? Because we are receiving it now. No. So that's why now we have to recognize that interest income. Next one, with respect to bills purchased, that means bill discounted. If the bill is discounted and if the duration of the bill is running over 2 periods, like for example, you have discounted the bill on 1st of March. The actual due date of the bill is actually 31st of May. In between there is a balance sheet date. On this, the bank got total discounting income of some 9 lakh rupees. How this 9 lakh rupees should be recognized? Understood the question scenario I have given? Assume bank discounted one bill on what date? 1st of March. What is the actual due date of the bill? 31st of May. Total discounting income is how much? 9 lakh rupees. Now how much discounting income will be recognized on 31st of March? Only 1 month related income. That is 3 lakhs will be recognized in this current year. Rest of the 6 lakhs will be recognized in next financial year. Why? Because discounting of the bills is like a financing activity only. We will recognize part of the income here, part of the income in the next year. Now what about treatment of the 6 lakh as on the balance sheet date? Where we will show that? We will show it under liability. Income received in advance. Unexpired discount should be treated as liability as on the balance sheet date. When the bills are collected here, no headache at all. No need to apportion. Why? Because you will be entitled to income only when you collect on behalf of the customer. There is no need to accrue here. Similarly, when you get an income because of rescheduling, you have to recognize that income over that rescheduled period. Like for example, for extending the due date, you got the income. So that income should be recognized over that extended period. If you are extending loan by 2 years, for that you got 2 lakh rupees of bulk income, processing income. This 2 lakh rupees of income should not be recognized all at once. This 2 lakh rupees of income should be recognized over that extended period of 2 years. Clear? Then they say something regarding reversal of income. As I've already told you, if the income is already recognized but not realized, we have to reverse it back. Not just income, not just interest income, all other related income also will be reversed. And also, if by mistake, if entry is recorded, that also needs to be reversed back. If error has happened, that also need to be reversed. If the error is identified in the same year, we will reverse it. If the error is identified in the subsequent years, we have to create a provision. Why? Because we can't reverse it there. Why? Books of accounts would have been already closed. So we'll create a provision. So next thing they will say about expenses. So interest expense, I need to perform analytical procedures, like do some comparisons. What comparisons we have to do? You can read it, not that complicated. And we even have to check the calculation of interest, like whether interest has been paid as per the agreements with the borrowers. In case of FDs, interest rate will be mentioned on the FD certificate. According to that rate only interest is paid or not. In case of inter-branch balances also, interest will be charged as per the rate decided by head office. Next one, apart from this, when all other operating expenses are there, like rental expenses, etc., whatever all other operating expenses are there, for that they say some common points. First, I need to check whether all that other expenses are covered by proper internal controls. I have to check their supporting documents also, and even wherever possible, I need to perform analytical procedures. And one more significant item will be provisions for NPAs, etc. There I need to check asset classification and correct percentage of provision is maintained or not. Another provision will be provision for tax. Since we also know about tax laws, you calculate the tax provision on your own and try to compare with management's calculations. And whatever other provisions are there, like provisions for guarantees, warranties, etc., then that you need to check it with suitable supporting documents. Then next thing they say about reporting. Some auditors are required to report to central government. Which auditors? Auditors of nationalized bank and auditors of SBI, they are required to report to central government. In their report, they need to mention some matters that you can go through what and all matters are required to be reported. In addition to that, and even that report should be as per standards, you need to give additional disclosure. When I say additional disclosure, what are the number of unaudited branches? Not just number of unaudited branches, what is the loans, advances, interest, income and expense of that unaudited branches also should be stated in the audit report. Like if 10 branches were unaudited, you have to mention then 10 branches are unaudited. Not just that number, you have to also mention what are the total advances of the 10 unaudited branches. What is the total interest income of the 10 unaudited branches? What is the total interest expense of that total 10 unaudited branches that also need to be mentioned. And even you are required to comply with 143 subsection 1 and 143 subsection 3 reporting requirements, but CARO is not applicable here. 143 subsection 11 will not be applicable. And in addition to that, LFAR also need to be reported, additional reporting requirement, which is applicable for all banks. And what matters has to be mentioned in the LFAR, that is already decided by RBI, and there is a time limit for submission also. On or before 30th of June every year you are supposed to submit. And one more thing, RBI has given a circular which says that if you are an auditor of any bank, while the performance of your duties, if you come to know about any fraud, or if you find any fraudulent activity, or if you find any transaction beyond the powers of the management, or if you found any foul play done by the management, these transactions are required to be mentioned to RBI. Regulator is here, RBI, you are required to report it to the RBI. Even SA 240 also says this, and even we need to check the compliance with the SA 250 requirements also. And this will be in addition to 143 subsection 12 central government reporting. And then finally, what things should be there in the risk management process? Nothing but internal control system. What components should be there? Majority will be same like components of internal control. Like those charged with governance should be involved in the risk management function. It should involve identification of risk, nothing but entities risk assessment process. Control activity should be there, actual implementation of controls, and whether these risk management controls are happening properly or not, monitoring also should happen. And even I need to check how far the computer systems in the bank are reliable. Why? Because today all the transactions are happening through this information technology. And finally, they are telling what are the list of reports. That list of reports you can go through. I am not going through that in detail. This is regarding audit of banks. And I would like to cover only one more thing from the audit strategy planning and program chapter, that materiality I want to cover. Why? Because I expect for this attempt they might ask a questions regarding materiality. So I can't say what is the logic behind it. Why? Because I have read some question papers, and by analyzing the pattern, I feel that in the current attempt they might ask a question from materiality. So just I will take some 5 minutes of time to explain how to decide that materiality levels and all. So relevant discussion is SA 320. So we know that as an auditor we should ensure that financial statements are free from material misstatements. And when we call a misstatement as material, when it is expected to influence economic decision of users of financial statements. And we know that materiality is not an absolute term. Materiality is a very relative term. That is, whatever I feel material in one circumstance, the same thing I can't find as material in another circumstance. Okay. And apart from that, so let us now concentrate on how to fix the materiality. They say simply one thing: determine the percentage and multiply that percentage with appropriate benchmark. Sir, what could be the benchmark, sir? Benchmark could be anything from the financial statements. It could be turnover, it could be net profit, it could be net assets, it could be total expenses. So whatever it is, you have to choose the benchmark using your professional judgment, and that should be multiplied with the percentage. For example, I have chosen 5% and I have chosen turnover as the benchmark. Turnover is 100 crores. So what will be my materiality level? 5 crores will be my materiality level. And the standard says that an auditor should determine materiality levels at 2 levels. What are that? Overall materiality, performance materiality. Nothing but whatever materiality levels which I have set or decided for financial statements as a whole, that I call it as overall materiality. Performance materiality means for each item of financial statement, if I am deciding separate levels of materiality, that I call it as what? Performance materiality. So I need to decide materiality at 2 levels: overall materiality, performance materiality. Sir, so many benchmarks will be there, no? How to identify which benchmark will be suitable? It depends on so many factors. They say that any item of financial statement can be considered. Sometimes there will be an indication in applicable financial reporting framework, like Schedule 3 telling the expense which exceeds a certain percentage of turnover has to be disclosed separately. So there is an indication that turnover can be used as a benchmark. It depends on entity's ownership and capital structure. It even depends on information requirements of the users of the industry, and sometimes there can be an indication in law and regulation also. So these are the various factors which will help the auditor in choosing an appropriate benchmark. And what are the sources from which you can select the benchmark. From where we can select the sources? See, if the current year financial statements are ready, no need to look for any other sources. We can select the benchmark from current year's financial statements. If the current year financial statements are not ready, then we look for other sources like prior period financial statements, interim financial statements, or quarterly financial statements we can look. Understood? So this is what regarding determination. And you will have one more question like a revision of materiality, when the materiality levels will be revised. It depends on so many circumstances like change in circumstances, availability of additional information, or change in assessment of the audit risk. So like that, so many factors will be there. Depending on these factors, even materiality levels can also be revised, and whatever materiality levels you have said, that needs to even form part of your audit documentation also. And there will be one small question where in under what circumstances even small amounts also could be material. Like sometimes law and regulation will say like managerial remuneration, no matter how small it is, it need to be reported separately. Similarly, related party transactions, no matter how small it is, it needs to be reported separately. And it even depends on nature of that industry also. Like users of pharmaceutical industry always want to know research and development expenditure. No matter how smaller that expenditure is, that will be disclosed separately. And it even depends on users' attention towards specific events like amalgamation, acquisition happening during the year. So these matters also, no matter how small they are, they will also be reported separately. Understood? So this is what I thought of covering. And I think as promised, we promised to cover 70% of the content, but if I am not wrong, we would have covered even more than that only. More than 70% we would have already covered. So yeah. So thanks for your patient listening for these 10 hours. Stop it. So, and one more thing, I wish you all the very best for your examinations. So limited amount of time is available for us. So don't try to come under panic and make the situation worse. Try to be calm. So whatever you have to do, that you should have done by now. So by taking now extra stress or extra load, you are not going to achieve anything. Instead of even putting more pressure, you are not going to do any good thing now by taking extra pressure. So whatever you have to do about the preparation, that you have done it. So just keep on revising the things. Don't try to concentrate on learning the new things or new concepts now. So all the very best, guys. Please do your exams very well. Okay, right. So that's all from my side. Take care, everybody. Bye.
Thank you very much, sir. Please give a round of applause. Thank you. Please be seated. Thank you very much, sir. Yes. Feedback ichara. So Monday's class will be in Ravi campus, first floor. I think you might have informed. Right. So as usual, please drop mails